My name's Aideen Riley. I am the national contact point for the Innovation Fund here in the department, and we've got a team from EY helping us deliver this today. So as the national contact point for the Innovation Fund, myself and the team regularly meet with potential applicants and provide them with any support we can. And the feedback we've been receiving is that people can sometimes have difficulties with both the financial file and the greenhouse gas calculations, and that is the purpose of today. I'm sure you're all aware of the Innovation Fund anyway, but it's one of the world's largest climate funding programs, and it's to decarbonise technologies and support EU climate targets. You've got your small, medium, large scale and your pilot calls. We also have a hydrogen auction, and for this year, for the first time, will be a heat auction, for decarbonisation of heat, which we're excited about from an Irish perspective. The new call will be launched in December. That will be followed by an EU Innovation Fund Day, and Ireland will host our own Information Day back here in this room in January, and potential projects will also have a chance to meet with representatives from SENEA, who run the Innovation Fund for the Commission, to talk through their projects. So, as I said, we'll be looking at the financial file and the greenhouse gas calculations today. So this morning we'll be looking at the financial file. We'll have a break. We'll also have lunch from 1 to 2, and after lunch we'll do the greenhouse gas calculations. EY, as I said, will lead the sessions on both those documents, covering best practice and concrete examples, and participation is actively encouraged. So I'll ask everyone, I think you got the Slido codes for people in the room. They should be on your agenda as well. You can just use your camera on your mobile phone to go to the Slido link and put in questions there. Old-fashioned, just raise your hand. We will be going around with mics, so for the benefit of those joining us on online and for the recordings, if you could speak into the microphones, that would be great. For people online, obviously, you can also use Slido as well and put any questions in chat if that's easier. So I'd just like to welcome EY then, who will introduce the start of our session today. So I forget, was yourself? Yeah. Thanks so much.
Good morning, folks. My colleague Mikko is just going to pull up the slides. He's dialing in from EY Finland. So Mikko, if you could pull up the slides, please.
Is it visible now?
Yeah, that's visible. If you could jump on, please. So I'll be very brief and hand over to my colleague Mikko. Mikko is a specialist in this space and has supported many companies to successfully apply for the Innovation Fund. And indeed, as part of the second session, my colleague Rita is dialing in from EY Portugal to do a deep dive on the emissions avoidance calculations as well. If you want to jump on there, please, Mikko. So that's just a high-level overview of the session. I'll do a brief couple of slides, but I'll keep it, as I said, very brief before doing the deep dive into what is going to be the financial information file, cost and weighted average cost of capital calculations, and then obviously session 2 being the emissions. So if you jump ahead again, please, Mikko. Yeah, so a brief intro. My name is Ross McKiernan. I'm a director in the Innovation Incentives team in EY Ireland. We're a team made up of about 30 or so engineers, scientists, technologists, and effectively we're incentive specialists. We support clients, businesses to avail of all things incentives, cash grants, R&D tax credits, etc. I'm a recovering scientist by trade. I'm not a tax person per se, but I would have spent a number of years in government funding as part of the Irish Research Council, managing some of the national enterprise funding programs and some of the European funding programs there as well. and obviously now supporting clients in EY to avail of incentives funding. Toby, you might just jump up for a second and introduce yourself. We'll keep things brief.
Thanks, Ross. Good morning, everybody. My name is Toby Sainsbury. I'm also a director in the Innovation Incentives team in EY. I've been with EY 6 months now. Prior to that, I was in the Department of Enterprise, Trade and Employment, dealing with national technology policy across manufacturing, semiconductor and AI. Prior to that, I was technologist at IDA. So I understand the IDA system, the client companies, Enterprise Ireland, and some of the policy initiatives. I was also involved with quite a number of government funding initiatives. I was on the board of DTIF and involved with other initiatives at a European level, like IPCEI and semiconductor funding. So now in this context, in the Innovation Incentives team, we're looking at the broad spectrum of grants and incentives to support companies. So decarbonisation, energy efficiency, absolutely one of our key priorities. So yep, happy to be here and looking forward to the discussions.
Okay, Migo, if you could jump on, please.
Absolutely. I'm not sure if I'm visible in the room, but try to turn my camera on at least. So my name is Mikko Virtanen. I have been working at EY for the past approximately 8 years, located in Helsinki, Finland, and basically I'm focusing mostly on M&A advisory and transactions, specifically from financial modeling and valuation angle. But given that the Innovation Fund has quite detailed and specific financial modeling related requirements, I have been working on various different Innovation Fund applications ever since 2020. So I think that probably have been working from different angles in roughly 10-ish application procedures. From sector perspective, I mostly focus on energy sector, including renewable energy, battery storage systems, district heating, etc., etc. And yeah, I think that's my background in brief.
Thanks, Mikko. Rita, are you online?
Yes, I am. So good morning all. My name is Rita Bernardo. I'm a manager here at EY. I've been with EY for 5 years. My background is in biological engineering with a specialty in environmental technology. And so I've been involved in the calculation of the GHG emission avoidance for Innovation Fund, for most of Innovation Fund calls, as well as other national grants here in Portugal. And yeah, that's what I've specialized a bit in for the past few years, and that's what I'm going to talk about today. I'm going to try to channel a bit of my knowledge and share it with you all.
Thanks, Rita. Mikko, if you could jump on with the slides, please. Yeah, very quickly, as you can see with the team we have online and myself and Toby in the room, the Innovation Fund and European funding typically isn't a sort of a solo effort. And, you know, given the complexities of the application process and all the pieces that have to come together, it does require very much a collaborative effort within company as well, and also across company, also in terms of supplier uptake and different relationships, etc. But the point being, we very much adopt that approach as well in supporting our clients through these applications. And hence, you know, Mikko and Rita have deep subject matter expertise in these areas that we can bring together very quickly to support our clients through that application process. Yep, jump on there, Mikko. Listen, I think we're all probably fairly familiar with what the Innovation Fund is. That's why we're here. It covers obviously a number of areas and sectors. Aideen touched on some of the timelines there in terms of the upcoming launch in December for the next round of funding. So I won't dwell on this piece, Mikko. If you just want to jump on, obviously these slides are going to be shared with you for any follow-ups, and myself and Toby are in the room to discuss any questions that you might want to or not want to raise, obviously as part of the public forum. that's just the scaling of funding, obviously, that's available from small scale, medium to large, and obviously the batteries call that was introduced in 24, clean tech and pilots as well. So nothing new, and I'm sure you'll be familiar with the different sort of gradings there. If you want to jump on, please, Nico. Yeah, just in terms of the statistics of sort of previous rounds of funding, obviously the 24 call, we're awaiting announcement of the outcome of that. Interestingly, you know, in terms of the subscription or applications to that, I think of the 359 applications that went in, it amounted to, I think, a grant ask of over 22 billion, and with around, I think, 2.4 billion available, the call was oversubscribed by a factor of just over 9. So obviously that's going to, how that plays out in terms of success rates, etc., will remain to be determined. But the large scale fund obviously being the most heavily subscribed or applied to, as consistent with 23. And I think, you know, if you look at the success rates within each of those funding calls, clean tech is probably would have had the highest success rate in 23 within each of those calls. Success rate for large scale being a lot lower at 40. If you want to jump on, please, Miko. So this, I guess, is probably the premise for the session today, and I think it's just worth flagging some of the areas where applications have fallen down historically. 23, if you look at the 281 eligible projects that came through, 4% failed on degree of innovation, which is pretty small. It's obviously a critical evaluation criteria, but the fact that was only 4% probably speaks to the fact that businesses are pretty well aware of how where their technology sits from a readiness or a state-of-the-art point of view. So the innovation kind of piece is probably easier to, in some regards, to understand where you sit along a scale relative to other applications or competitors. Obviously, when you look down through this funnel, financial maturity is a big point of failure for those applications that got through or that were eligible and hence didn't get funding. And I guess, you know, the emissions avoidance piece as well is there. And those are the two areas that we're going to do a deep dive on to kind of to bring it through. And Miko and Rita will obviously bring those tangible examples and use cases based on their experience with applications, and also jump out of the presentation into some actual, you know, practical examples as to how those calculations and models are pulled together. Miko, jump on, please. Yeah, that's an overview of the application process. I'm sure you're pretty aware of that. The mandatory annex is obviously considered major deliverables as part of the overall application process. You know, we can discuss the broader application, you know, at coffee break or any questions you have around that. But again, the focus being the CHG and the financial modelling for today. Miko, if you could jump on, please. And this, I think, is just a useful sort of visual in terms of the stage gates and the project life cycle. Obviously, feasibility study being emphasised there as critical, but those stage gates of grant award and that 4-year maximum duration for project prep, the ability to draw down up to 40% of payment during that period, but then hitting that financial close stage gate is critical. Moving into a drawdown of 60% of funds, and then entry into operation where you have at least 10% of that drawdown at that phase, moving into annual cycles and reporting up to a period of 5 to 10 years out. So, you know, knowledge of that sort of life cycle and foresight and planning is obviously kind of key as part of the application process. Want to jump on there, please? Yeah, just I'll conclude on this and hand over to Mikko, and I certainly won't dwell, but these are the award criteria. I guess, you know, these shouldn't be considered in isolation. Obviously, the application has a lot of moving parts, all of which are tied together and evaluated as a whole. It is useful to just kind of flag these, bear them in mind as we work through the session and the workshop, because how the financial modelling, cost efficiency, emissions avoidance modelling, etc., all feeds into the application, you know, and how it gets evaluated is obviously sort of key for success. And again, we'll share these slides afterwards, so we don't have to sort of read through these. But I think with that, Mikko, I'll hand over to you if you want to take us through the financial modelling piece.
Thanks, absolutely. So let's jump into the subject matter. First, going through the agenda that we're gonna discuss today. So first, we're gonna have a brief introduction on the kind of proposal evaluation and how the financial information file and applicant's financial model plays into that. Then we're going to have a look at the eligible costs, like cost and revenue categories that you should be including in the relevant cost calculations, which then determine the maximum grant amount that your projects would be eligible for applying. Then we're going to have a look at the weighted average cost of capital determination from the perspective of the innovation fund. It's quite clearly defined there. And then as a closing part before the short coffee break, we're going to look at a couple of general tips and tricks that we've learned in preparing the applications previously. Then after the coffee break, we're gonna jump into a brief demo session. We're gonna show you our take on the applicant's detailed financial model, what kind of sensitivities are there, what kind of figures you should be usually presenting there, and how that then feeds into the kind of financial information file template prepared by the Innovation Fund. And if you happen to have any questions at any point during my presentation, please, it's fine to interrupt me. And yeah, as the guys in the room said, please speak to the mic so that everyone can hear the questions. But happy to take any questions during the presentation. But we definitely also have a kind of dedicated Q&A session after the slides have been walked through. So let's first start with why this is important, and from the Innovation Fund perspective, and how the kind of proposals are evaluated. So basically, the evaluation of the proposals goes in a cascaded approach. First, the degree of innovation is being evaluated with the maximum points of, I think it was 15. If I'm not mistaken. But anyway, there's a minimum threshold of 9 points that you need to gain from the degree of innovation in order for the evaluation to continue. And if you don't, then the evaluation stops and your proposal will not be eligible for further evaluation. Next, the GHG emission avoidance potential and project maturity is being evaluated. And there are also kind of minimum criteria or minimum points to be received from both of these areas in the application. So you need to score a minimum of 3 points from the GHG side and 9 points from project maturity. And project maturity is split between financial maturity, technical maturity, and operational maturity. And again, if your project doesn't meet those thresholds, the evaluation stops and the project won't be eligible for further evaluation. And as seen in the previous slides, this project maturity side of the evaluation is extremely important, and many of the projects fail, especially in the financial maturity. And given this fact, it's quite important that the kind of financial aspects, financial model, and financial information file are prepared appropriately and correctly. Then finally, the replicability and cost efficiency of the proposal are being evaluated. In the cost efficiency side, there is also a minimum pass score of 1.5, and you need to meet that. And in case you meet all of these kind of criteria, then the grant could be awarded. Obviously, it's possible, and there are often cases that kind of the minimum thresholds are passed, but then again, because it's quite competitive application, you may not have kind of enough points in order to be awarded the grant anyway. Good. And why does the financial information matter, and why it is so important part of the application? So as discussed, it's part of the evaluation of the financial maturity, which is the key criteria where applications usually fail. And as said, you need to reach the minimum of 3 points in the financial maturity in order to be evaluated further. And what's actually measured in the financial maturity is practically the kind of ability or perceived ability of the project to reach the financial close within 48 months after the application or the project start date. And how that is being measured is basically that the evaluators are looking at the general credibility of the business plan and how the funding of the project is expected to be arranged. We will go more into details on that in the later slides, but basically the applicants need to provide a lot of supporting evidence, memorandum of understandings, LOIs, term sheets, etc., kind of supporting written materials to evidence that the financial maturity is there. Second of all, the financial information file calculates the so-called relevant costs, and relevant costs are the key driver in estimating how much grant your projects are eligible to applying for. So the maximum funding amount for each individual project is 60% of the relevant costs. That's also a topic that we will go into more details on what's included in the relevant costs and how that's actually being calculated in the following slides. And the last point where the financial information file matters a lot is the quality of the cost calculations. And basically the cost efficiency ratio, that's the only thing in the application where you know already when submitting how many points you will be receiving there. And there is a kind of clear formula of how the cost efficiency ratio is calculated, and it's basically driven by the amount of grant requested divided by the GHG emission savings from your project. And this part of the application does not have so high scoring altogether, maximum of 3 points with a minimum boundary of 1.5. But anyway, it's kind of a criteria that if you don't meet the quality or appropriate quality, your application may be rejected altogether. Then what actually is the financial information file? It's one of the key mandatory annexes that has to be provided as part of the Innovation Fund application. And it's basically an Excel template that has been prepared and provided by the Innovation Fund as part of the materials in the fundings and tenders portal. The document calculates all the key investment metrics of your project as well as relevant costs, and then it showcases the financial statements, including profit and loss balance sheet and cash flow statements of the projects. And that's the key element that the evaluators start with when assessing the financial maturity of the project. Obviously, there are other elements as well, including kind of the applicant's own detailed financial model and business plan documents, etc., etc. But kind of the key outputs of the project are in the financial information file. And that's where the evaluators often start with. What you need to input to the financial information file is basically general project assumptions, including the timing, let's say project start date, entry into operations, construction start dates, etc. You need to calculate the discount rate, which is corresponding to the innovation fund methodology of calculating weighted average cost of capital. Sources and uses of funds. Depending on your project type, you need to input the kind of production, whether it's then heat delivered or kilograms of some metal delivered, etc. It can be anything depending on the nature of your projects. Then you need to input the other revenue drivers, operating cost drivers, cash flow statements, and balance sheets, etc. Second of all, the capex, obviously part of the cash flows, but there is given that most of the projects are quite capex heavy and capital intensive, the capex sheet is separated and it's kind of has to be input on a quarterly basis. Otherwise, the model is constructed on an annual basis. Then there are certain specific inputs that need to be filled in terms of relevant cost calculations. We'll have a look at that a little bit later. And then there is the kind of breakdown of grant, when you expect to apply for the money and for what kind of work packages you are applying the money for and when the drawdowns happen. And as already said, the kind of the outputs reflect the financial statements and key investment metrics of the project. It also calculates the relevant costs as well as the cost efficiency ratio and gives certain supporting elements that have to be inputted in the part C of the application package. This is kind of a brief summary of the financial information file, and we will go into much more details and look at the actual document in the later part of this presentation. But this is just to give you an idea of what the file contains and why is it a necessary appendix as part of the application. Next, let's have a look at the relevant costs in a bit more detail. And given that this sorry, was there a question? Oh, apparently not. But anyway, in terms of the relevant costs, there is a clear definition in the documents how the relevant costs are calculated and how it's defined. So according to the relevant cost guidance, the relevant costs shall be the net extra costs that are borne by the project proponent as a result of the application of the innovative technology related to the reduction or avoidance of the greenhouse gas emissions. And this is quite unclear way of saying it. I don't know whether anyone understands based on that definition what has to be included there, but luckily there is quite a comprehensive document on the calculation of that. And there are actually two different methodologies of measuring this. First of the methodologies is the no reference plant methodology, and second is the reference plant methodology, where the no reference plant is actually the standard and the preferred methodology which is being used in vast majority of the situations. And in my nearly 5 years of experience in the Innovation Fund, I have never seen the reference plant methodology being used in a real life case. Obviously checked in different occasions whether that would be eligible, but like I guess that at least 95% of the cases use the no reference plant methodology. The relevant costs are measured during the construction period and for the first 10 operational years. So any costs during that period can be considered as relevant costs if they kind of fit in the definition. And only costs after grant signature date can be considered there, but there are certain specific cases and exceptions where costs after the submission of proposal can be accepted as well, even though the grant signature is not yet made. The standard no reference plant methodology basically calculates the relevant cost as the sum of capex, including all construction costs related, etc., related to the projects. That is not discounted. Then OPEX and maintenance CAPEX, that's calculated on a net present value basis. So any OPEX and any maintenance CAPEX is discounted to present value based on the weighted average cost of capital that we'll look at a bit later. Then any operational benefits which, well, they are separated from revenues, but practically from accounting standpoint, those could often be recorded as revenues, but the FIF defines operational benefits such as ETS allowances or CO2 sales as separate part of the revenues. But operational benefits and revenues are also discounted to present value, and that's how you get the kind of, as a sum of those 4 items, you will get the relevant costs in the no reference plant methodology. And the second so-called reference plant methodology calculates your relevant costs as basically the cost and revenue differential of your innovative project when compared against like a project which would be constructed with conventional technologies. And there could be different discount rates and different weighted average cost of capital in the kind of reference plant and your innovative project, but kind of practically speaking, the calculation method works exactly the same as in the no reference plant side. However, in the reference plant methodology, you need to calculate kind of the capex, opex, and revenues separately for a so-called reference plant and compare those against your innovative projects, and then the relevant costs would be calculated as the sum of these 2 elements. And we'll have a look at kind of actual case examples of both methodologies later. Then let's have a bit more detailed look at what actually can be included in all of these kind of relevant cost items, starting from the revenue and operational benefits. So that's practically all revenues and all income generated by the project that should be reflected in the financial information file and also included to the relevant cost calculations. So first of all, obviously, any sale of the end products, which can be depending on the project type, it can be heat, electricity, metal, chemicals, whatever, you name it, basically. So the quantity can be anything depending on the industry and the type of the project. And obviously, in addition to the quantity, you need to estimate the sales prices and have supporting evidence for those as well. Then the operational benefit side includes the ETS allowances. So if you are operating in a sector that's eligible to receive any free CO2 allowances, which as a result of your innovation fund project, you won't have to use yourself, but you can sell them to the market. That can also be and should be included in the relevant costs. Also, if you're capturing CO2 and selling it as a byproduct or sometimes even as the final product, that's part of the relevant cost calculations, and any other kind of GHG certificates that are not reflected anywhere. Those are basically the four main items that have to be included in the relevant cost. However, there are certain exclusions from the relevant costs as well, and normally, even though there are some costs or some revenue sources have to be excluded from that calculation, they need to be reflected in the FIF, but input on a separate row such that they are not considered in the relevant cost side. So any other public support that you have received for the project or expect to receive for the project, that is not included in the kind of revenue side of relevant cost calculations. That has to be considered when calculating the cost efficiency ratio of the project. But the idea of this is that it's kind of the innovation fund is indifferent on what is the support sources of your projects, and the only thing is that you need to calculate the cost efficiency ratio such that all the public funding support is reflected there. OPEX side, it's a bit more detailed, and there are a lot more exceptions on what can be included and what cannot be included. But generally speaking, all the kind of operating and maintenance costs, cost of goods sold, decommissioning costs, stuff like that can be included in the relevant costs. Obviously, from decommissioning cost side, they can be included only if they occur in the 10-year measurement period. So recalling from the previous slide that only 10 years from the commercial operations dates are included in the relevant cost calculations. And if the project lifetime is longer than that, then decommissioning costs are obviously excluded. The Innovation Fund has separated the leasing cost approach depending on whether it's whether the lease is a financial lease where there is an obligation to purchase the asset at the end of the lease period, or whether it's an operational lease where such obligation does not arise. And financial lease costs can be included in the relevant cost side, but operational leases are kind of by definition excluded, and those are not allowed to be included in the costs that will be funded. Then other kind of nuances on the OPEX side that you can consider including is R&D costs. If there are any OPEX savings when you are kind of substituting from kind of traditional technology to new project, those should be included in the OPEX side as well as kind of netting element. And contingencies is an important factor, given that there are likely at the time of the application you are unaware, or there cannot be like 100% confidence on all cost items. The Innovation Fund does allow including contingencies to both OPEX and CAPEX side, but any contingencies have to be thoroughly explained and justified in the other application documents. From OPEX side, depreciation and amortization is excluded, but this is clear since kind of CAPEX is considered separately. So if we would include depreciation or amortization, that would be basically double counting our investments. Any costs linked to debt financing are excluded, and practically speaking, kind of debt financing costs are reflected in the weighted average cost of capital, which is used in discounting the relevant costs. So theoretically, it would also be kind of double counting if we would include those costs as well. As said already, operational leases are excluded. Then VAT, any taxes, those are not included in the relevant costs. And any royalties paid to project shareholders, and this is important also from the CAPEX side where we will be coming to, but if any of the project shareholders own some IP which would be licensed to the Innovation Fund project, those royalties paid to the actual project shareholders are directly excluded from the relevant costs. And if there are any kind of communication, marketing, reorganization costs related to kind of switching from existing products to new products, those are also outside of the funding. And as well as any OPEX subsidies. So this is similar to the kind of revenue side. So any OPEX subsidies have to be excluded from the OPEX side, but they are definitely considered in the cost efficiency calculation. Then we're jumping to CAPEX and maintenance CAPEX. So that's basically all costs related to the development and construction of the project before entry into operation. And maintenance CAPEX is separated. Maintenance CAPEX is basically defined as costs necessary to maintain the project's operational capacity. And the difference in relevant cost calculation is that CAPEX is taken at face value, not discounted, and maintenance CAPEX is discounted. But practically what's included is any construction costs, costs related to kind of construction and development of the physical assets and operational infrastructure of the project. Development costs can be included, which could include, like, I don't know, ground studies or some kind of feasibility studies, etc., which are necessary for the completion of the project. Intangible assets can also be included. However, there are separate, quite specific conditions and rules on how intangible CAPEX can be included. And as is the case for the royalties paid to project shareholders, any intangible assets which are purchased from the project shareholders, those have to be excluded as well from the calculations. Also, as mentioned, the contingencies on CapEx side definitely allowable, but those need to be kind of justified. The calculation and reasoning for any contingencies need to be explained in the applications. Strictly excluded then is any expansion CapEx. So if the project's operational capacity, volumes, etc., are expected to be expanded during the operational lifetime, that has to be excluded from the Innovation Fund application and also from the financial information file. So what the financial information file should reflect is basically quite clearly defined projects, and if there are plans to expanding that later, that definitely cannot be part of those calculations. Intangible asset purchase already mentioned. Then also kind of write-offs of old assets. So if we are replacing an existing installation with a new innovative one, any old asset write-offs cannot be included, as well as terminal value of assets, that's also excluded, which is consistent with the fact that the financial information file should reflect the full project lifetime from the start of the project to the end of the operational lifetime. So there theoretically should be no terminal value of the assets remaining at the end of the project. And other public support and CapEx subsidies, similarly as revenue and OpEx side, excluded from the relevant cost side. Next, we're going to have a look at a practical example. Those are obviously illustrative figures on what's actually kind of from P&L and cash flow perspective, what you can include to the calculations. So if we are looking at the project with an start date of the project or grant signature date at the end of 2026, we can include costs starting from the beginning of 2026, but any costs in 2025, those are excluded, since the rule says that anything after grant signature date is basically included in the calculations. Then we have construction period. In this example, it would be between 26 and 27. So there would be some interest expenses going on and CapEx going on during that period when we are paying for the construction costs. So all of these items on the CapEx row, those can be included at face value in the relevant cost calculations. Then let's say that our entry into operations is in the beginning of 2028. That would mean that any cost during the 10-year period starting from the beginning of 2028 can be reflected in the relevant cost calculations. But when the 10 years after entry into operations has passed, any kind of costs or revenues after that period are not included to the calculation. Then from the line item perspective, as discussed previously, what we can include is revenue, COGS and OpEx on a discounted basis. Any depreciation or bank costs or interest expenses are excluded. And from other cash flow items, basically CapEx is then the only one that is separately included in the relevant cost calculations. And if we have a look at how those numbers on the previous slide would fall or calculate into the total relevant costs and into the maximum grant, it would basically go like this. So CapEx you take on an undiscounted basis, then maintenance CapEx, any operational expenses and revenues you would be discounting to present value with the WACC, and the sum of those during the construction period and the first 10 operational years would be your total relevant costs. And the maximum grant, which is then driven by this number, is 60% of the total relevant costs. So in this illustrative example, the total absolute maximum grant amount that you would be able to apply for would be 31.9 million euros. All right. So the last point that we haven't touched upon yet in relation to relevant cost determination is the definition of discount factor. So the innovation fund has quite clear guidelines on how the discount rate or WACC is calculated. And what's basically measured there is a cost of capital for the target project. So in case you are operating as part of larger group or a larger company, you cannot really use your companies or groups total WACC, but you need to calculate the cost of capital separately for the target project. That's quite important nuance to keep in mind. And basically this number is then used in discounting the relevant cost as presented on the previous page. And we can have a look at each of these parameters separately. So from finance theory perspective, beta is a measure of the riskiness of the target project or target equity against the market index in general. So if you have a value of 1 of beta, you are basically saying that your project is as risky as the market in general. Obviously, in real life, maybe it's important to comment already here that in real life and how would kind of market participants or funders evaluate the cost of capital for such innovative projects is likely quite different on how the innovation fund defines it. And usually we are getting very low numbers for weighted average cost of capital according to the innovation fund methodology when we would compare it how actual kind of equity financiers would look at the project. So default value for beta is 1. There are certain sector-specific betas included in the relevant cost guidance, which you can use. But if you deviate from the standard number of 1, then you need to justify that separately in the application, why you have decided to do so. And if you just use the default value, that doesn't have to be kind of separately explained anywhere. Risk-free rates are basically a measure of the zero risk investment of the target market, which usually can be considered, for example, as a benchmark yield of low risk or high credit rating government bonds. The relevant cost guidance includes a long table which defines the risk-free rates for each of these countries separately, and 1.1% that we have here is reflecting Ireland based on the previous relevant cost guidance. Equity risk premium, that then kind of measures the market's expectation of additional returns generated on top of the risk-free rate, given that you are investing in a risky project. There are certain different ways of defining that, but the standard innovation fund methodology says that the default value is 6%, and there is also a table for country-specific ERPs in the guidance document. But generally speaking, if you select to use the 6% standard rate, then there is nothing further to be explained. Then, given that we are looking at like innovation projects that have likely never been made in at least in similar scale in other parts of the world, we should argue that our projects have higher risk in comparison to standard equity investments, and innovation premium targets to reflect the kind of additional risks related to the innovation fund projects being kind of first of a kind and therefore carrying higher risk in comparison to conventional projects. And 3% is the standard rate for innovation premium, but it can vary between 2 and 4%. And again, if you vary from the standard approach, that has to be separately justified in the applications. So from cost of equity side, when we sum these together, we get to 10.1 as the standard. And all of these parameters are basically defined to you in the relevant cost guidance. But as said, there are kind of alternative approaches if you wish to do so. But if you want to go with the standard approach, this is basically how it goes in the previous relevant cost guidance. Then from cost of debt side, it's a bit more subjective in nature. So, well, first of all, the base rate. So that is being defined as corresponding to the swap rates in the relevant currency. So if we are looking at a project in the Eurozone, we can have a look at what's the Euribor rate corresponding to the maturity of the potential debt that's being raised. But this is not defined separately in the relevant cost guidance document, so you would need to get some market data to support the base rate applied in the cost of debt calculation. Then credit spread, ideally and optimally, that should be supported by term sheets or any kind of preliminary understanding of potential debt terms available for the project. And this is basically, there is no clear guidance in the relevant cost methodology how this should be determined, but obviously if you are planning to raise debt for the project, and if you are saying in the innovation fund application that that's the case, you definitely should have some supporting documents, include, for example, term sheets, which then state the applicable credit spread. Corporate tax rate, that's just the standard statutory income that tax rates in each of the jurisdictions. And based on these numbers, you then get to the after-tax cost of debt. And then the final element in the calculation of cost of capital is the debt to total value or debt to equity ratio of the project. And here are also a couple of nuances how that should be determined. So it should be consistent with and corresponding to the actual funding or the capital investments expected to be happening in the project, including any equity injections or shareholder loans, which are then kind of treated as equity overall, and any external bank loans or any external debts to be raised in the project. But when you are calculating this ratio, the grants should be excluded. Any grants received should be excluded. So if parts of your funding sources are coming from the EU or any other grants, then those should not be considered in this ratio calculation, but it should only reflect the kind of equity capital invested by the project owners as well as the potential actually external bank debts.
Mikko?
Yep, please go ahead.
It's Ross here. Sorry, I have a question around the calculation here, right? So from your perspective, what's your sense as to how an evaluator would look at different approaches here? So there's obviously default ranges here and guidance for applicants to follow. To the extent they deviate away from default guidance, how do you think evaluators would perceive that? Did they want to see that there's very much stringent alignment with defaults, or do they like to see that there's a lot of, analysis going into positions taken that are not default?
Yeah, that's a good question. And as a general guidance, I would perhaps prefer going with the kind of standard approach defined in the relevant cost guidance, especially for like these parameters that we have here. And if you decide to kind of deviate from the standard approach, definitely use the numbers that are shown in the relevant cost document instead of trying to do your own market analysis, which is not then corresponding to the relevant cost guidance. Because even though, yes, from financial theory perspective, these parameters may look a bit weird, and often they are, but if you start doing kind of own analysis and try to justify using different numbers that are in the guidance document, it easily results in a situation where the kind of cost efficiency calculations are not done according to the guidance, and the project may be disqualified for that kind of a stupid reason. Hope that makes sense.
Yep, thanks.
Maybe the last point on the cost of capital slide is here outlined in yellow. So when we are calculating the project IRRs, like the ideal situation, what we are trying to showcase all together in the financial information file is that our project is not financially feasible before the grant, but after receiving the grant, it does become financially feasible. And how that is being measured then is that basically based on the comparing the project's IRR with the weighted average cost of capital. And if our IRR before receiving the grant is below the cost of capital, then we can argue that, okay, our project needs external support in order to be financially feasible. And if our IRR after receiving the grant is higher than the weighted average cost of capital, then basically we can argue that, okay, this grant actually does make a difference and does turn the project financially feasible. And if we compare that to a situation that, theoretically speaking, our relevant cost calculations could show that we are eligible to apply for grant funding, even in situations where our project IRR before receiving the grant is higher than weighted average cost of capital. But then the question comes that why does your project actually need subsidy funding if it's already profitable before the grant? So kind of the ideal relationship between the IRRs pre-grant and post-grant to WACC is that basically pre-grant IRR should be below WACC, post-grant IRR should be above WACC. Then a couple of slides on the general tips and tricks in relation to relevant costs and filling in the financial information file. So what we normally recommend is that the relevant cost should be estimated as early as possible, even though definitely there are situations and usually financial modeling is quite iterative process, which results in the relevant costs and your IRRs and everything changing multiple times during the preparation phase. But we need to have a rough understanding of where the relevant costs land, even when, like at the very beginning of starting the application process, just so we can understand how much grant funding we are actually potentially eligible applying for. And the second point, this is probably something that I can't stress enough. This is extremely important. We can have a look at the kind of graph a little bit later, but any supporting documentation that you can have in justifying the assumptions taken in the model, that's the key to scoring competitively in the financial maturity score and building like a financial information file and a model which is kind of credible and understandable. So whatever you can gather around like letters of intent, who is buying the end product, how much does the construction of the facility actually cost? Can we have some, let's say, preliminary quotes from contractors in relation to the CapEx? Can we get some term sheets from the banks who are potentially looking at financing the projects? How strong commitment letters can we get from the project shareholders in terms of the equity financing that they're actually committed to constructing and funding the project? This is basically gathering as much credible supporting evidence as possible. That's like the absolute most important thing that I would say in relation to building a kind of competitive scoring in the financial maturity section. Then third point, which is quite important as well, is that we need to assess various scenarios, and one part that is actually necessary in the business plan section of the applications is sensitivity and risk analysis. And we recommend building the applicant's own financial models in a way that it allows us to easily understand sensitivities and easily understand the impact of changing various operational assumptions to the relevant costs, IRRs, etc., etc. And basically what we are looking at here is that we need to be able to answer to the questions, okay, what happens to our project if the market prices of the end product move like plus minus 10% to each direction, or what happens if we have misevaluated our capex contingency and the capex ends up being exceeded by 10%. Like we need to be able to answer those kind of questions, and that also answers us, okay, how much it actually impacts the potential grant to be received if that happens. We didn't go through kind of the inflation point is that I haven't covered yet, but there can and should be inflation applied on the revenue and cost side. So if you are, for example, benchmarking your costs against current levels, if you have an existing facility which is using similar resources and you are justifying your OPEX levels based on that, you don't have to kind of use the flat cost levels, but you can use inflation expectation on top of the numbers. But also bear in mind that any inflation that this is used has to be justified based on, like, I don't know, market experts or like external databases which provide inflation forecasts. And the last point is that based on our previous experience of working with various projects and various different versions of the financial information file template, even though you would read the relevant cost guidance and financial information guidance through like 1 million times, there are always exceptions and always special cases. And the FIF template has been developed multiple times during the past years, and we have many times identified that actually the FIF does not reflect our project's current state appropriately, and it there are these cases that you cannot really kind of prepare for in based on any of the available documents. And there is a help desk in the Innovation Fund, and based on our experience, it's quite good in replying to all of the potential borderline and special case questions that may come during preparation of the financial files. Then looking at the kind of reasons for failing in financial maturity, which is the data on the right-hand side of the page is published by Cinea. And most common reasons for not being able to perform well in the financial maturity, as said earlier, is the assumptions in the business plan not being credible. And this boils down to the fact that we need to be able to support with any kind of external evidence, external documents, any assumptions that we take in the model. And what we need to be able to answer with the supporting evidence is basically questions like what is the market, who we are selling to, do we have any kind of fixed offtake agreements, and if yes, how committed is the offtaker to actually purchasing our project or products when the project is operational. What if we sell like product like electricity, which has a kind of functioning retail market? What is the risk to electricity price fluctuations, etc.? Then other stakeholders outside of the kind of revenue and offtake side, who are kind of the providers of the construction services, like meaning that basically supporting evidence to the capex has to be quite credible. If we can have like preliminary quotes or kind of budgetary offers, that's great. And any other external documentation that we could have to support the assumptions taken. That basically is the key to building credible business plan. And the form of those LOIs and term sheets, that's also important. So they need to be able to when the evaluator reads it, they need to have a kind of understanding that this counterparty actually is committed to this project, and like we would recommend avoiding having like generic LOIs, but actually edit all of those LOIs and have them specialized and tailor-made for the project at hand. Second point, which is sometimes, well, it's not a big reason for failing in financial maturity. Only 4% of the cases kind of fall in inconsistencies. But this is very important also to keep in mind, because this is something that we can actually influence ourselves. So making sure that all the numbers in the various application documents are consistent, calculations in the FIF, applicant's own financial model, business plan, part B of the application document, those are consistent. Parameters applied, etc., are consistent with the guidance given in the relevant cost calculations. Those have to be consistent. It's good to keep in mind that the same numbers that we present in the financial information file may appear in like tens of different places in the application document. So there's a lot of cross-checking to be made before submission in order to avoid like failing for kind of unnecessary reasons due to the inconsistencies. Then financing is kind of, there are basically all of these elements are somehow related to financing. First of them being unprofitable project combined with not credible financing plan, and this is basically related to the point I made about the relationship between internal rate of return and WACC. So it could be possible that your project receives the funding even though your post-grant IRR does not exceed the weighted average cost of capital, in case you are really able to showcase that our project shareholders are actually committed to funding the project. So in case we have this kind of situation, it's even more important that we are able to showcase like clear commitment to the funding and clear commitment from the project shareholders. Then maybe these two like gray areas here, financing plan not credible, no evidence of commitment, or debt without repayment capacity and lack of evidence. So if we are saying in the application document that there will be some debt raised in the project, it's extremely important that it's actually supported by some other assumptions like actual term sheets and discussions with the banks, in addition to kind of just having expectations that this may be possible. Good. Then going to the final slide of this first session, I think that we will have a few minutes for questions also before the coffee break. But this slide basically presents like a graph showcasing the scoring in cost efficiency ratio in comparison to the grant requested, and this line is calculated based on the numbers or the grant numbers presented in the previous relevant cost slide and an illustrative figure of GHG avoidance of 750,000 kilotons of CO2. And this is as I said earlier, this is the only part where we can actually know our points in advance, even before submitting the application document. So we are able.
Mikko, your sound has dropped there.
Am I audible now?
Yeah. We lost you pretty early in that slide. If you want to start from the start of that slide again.
Sorry, can you hear me now?
Yes.
Okay, perfect. When did my sound cut off?
Yeah, we lost you pretty early in the slide. If you want to start the slide again, Mikko.
Okay, yeah, of course. So basically, this slide is about optimizing the kind of request for grant and thinking about how much funding should we apply for, given this is the only factor in the application process where we know the scoring already in advance. So this is an area where the applicants can actually optimize slightly on their scoring. And this line here, the white line, is calculated according to illustrative GHG emissions savings of 750,000 kilotons of CO2 equivalent, and basically showcasing how much points we can receive per kind of the requested funding rate. And this yellow line then showcases the kind of maximum possible grant based on the previous illustrative figures on the relevant cost calculations that we showed on the previous page. And the point that we're trying to make on this slide is that even though you would be able to theoretically apply for a bit over 30 million of grant in this illustrative case, it would lead to a cost efficiency ratio score of 9.5. But since we know based on previous data published by SINEA is that the kind of successful projects have historically had median cost efficiency ratio of 11 or above, we should consider whether we can make our project profitable even with slightly lower funding, which would give us more points in the cost efficiency ratio. But this is all interlinked together with the total kind of application credibility and feasibility. So if we decide to apply for less grant in order to score higher in the cost efficiency ratio, our projects should still be able to kind of showcase adequate IRR and adequate financial performance for it to be kind of considered positively in the applications. But if you do have like very high CO2 savings and otherwise competitive applications, so that you are confident that you are receiving high scores in all of the other areas of the applications, obviously kind of the maximum grant amount that you can apply for is then 60% of the relevant cost, and you don't necessarily have to apply for less, but this is just good to keep in mind in terms of the application strategy as well. All right, I think that there are 2 minutes remaining before the coffee break, and we can have a couple of questions for now if there are any.
Yeah, thanks so much, Mikko. I know there's some questions online on Slido, but I'll go to the room first. If anyone has a question, if you just raise your hand. Thanks, Grania.
Hi. Thanks so much, Aideen and the team, and to EY for organising today. It's been really insightful so far. I was just wondering, with the new Annex 3 in the latest iteration of the call feat, is it envisaged that like the scoring for financial maturity will be harder, or that they expect like that failure rate of the 39%, which is a stark figure, that will improve? Is the expectation higher from SINEA, do you think, or is that just extra guidance, but they always expected that level of detail in terms of the supply terms and the kind of shareholder commitment, etc.? Thanks.
Yeah, that is a very good question, and I'm not really able to directly answer to that. We can take a look at like yeah, this is probably something that I'm not really comfortable with giving detailed answer at
No,
this
but if
moment.
I just interject there, I think it is a part of like Sene have got the feedback as well that they want like these two, the greenhouse gas and the finance, to be clearer and more transparent and easier to understand for applicants. So I don't think there's been any real change, but they're just trying to make it more transparent. Yeah.
And I think maybe just to add to that, to the MOUs, the LOIs, etc., I think that is going to remain to be really important as part of the app, to demonstrate validity of the financial model, to have all of that documentation in place. So I don't expect that there'll be a slimming down or a sort of a request for that type of supporting material beneath the model.
Then on the sector-specific beta question, as said, we are aware and have been having discussions with various clients on the fact that the Innovation Fund WACC determination does not really reflect the reality so often, but we actually, just need to go with the numbers that we have in the relevant cost methodology, and that's the unfortunate fact.
Super, cheers. Thanks for that. The last slide was particularly interesting on the cost effectiveness and the overall grant request. I was wondering, when you refer to the grant request, is that just a request from the Innovation Fund, or would that include other grants such as, let's say, national support as well?
Yes, exactly. So the cost efficiency ratio, if you have any other national grants or EU grants in your project, the cost efficiency ratio includes all of those grants.
Okay, if we go to the next question then from Slido. Is there a rough back of napkin calculation that can be done for scope and projects and their potential for success in applying for the Innovation Fund? No. Yeah. But if you want to maybe expand on that, yeah, I would have to agree with the room. No.
Yeah. If we are looking at that from financial perspective, I mean, I guess that we will be able to make a rough back of napkin calculation on kind of the potential funding amount that the project could be eligible for. But then if we are looking at it from wider perspective of whether the project actually would be eligible for funding, that would need like a quite extensive analysis. But obviously, if we just want to have a look at the relevant costs, that could be done quite quickly if we have a good understanding of the project financials.
Perfect. Anyone else in the room? Oh, yeah, we'll take this one first. And thanks. Next.
Hi, this is Adele Wise. I'm from the Carbon and Energy Fund, and I just have a question on the weighted average cost of capital. The application of the ratings, is it the same for PubSec and private enterprise?
Sorry, could you elaborate? I think I missed.
If there's a project that is being delivered in the public sector, does it carry a different risk weighting than a project being delivered in the private sector?
No, okay, yeah. I think that the kind of the WACC parameters, weighted average cost of capital parameters, they are the same regardless of where the project is deployed. There is no difference in that methodology.
Thanks. We've just got another question in the room, and then I'll go back to Slido.
Yeah, I had two questions. One is on the funding side of things. It seems, at least the way I understand it, confusing to me that you need to demonstrate project funding for a project that is below WACC beforehand. So getting your equity commitment, your debt commitment, and then it's financially viable with the grant, albeit you don't show the grant in the application. So just wondering if my understanding of that is correct. And then secondly, specific to our own experience in application, just wondering any feedback or thoughts on how we had a difficulty with our application historically, being that our product created a cost for the industry, which we at the time applied as a price discount to make the product price equivalent in the market. And if there's any feedback or initial thoughts on that.
Yeah, okay. So from the first, sorry, I think my headset is maybe crackling a little bit. If you could repeat the first part of the question.
Yeah, sure. So I suppose to me it seems inconsistent that a project that is below your WACC, which the Innovation Fund is seeking for your project to be, demonstrate full funding from an equity and debt perspective, in the sense that why would your board sign off on a project under such circumstances, and then is above WACC with the grant application, yes, you don't factor that into your WACC initially.
Okay, understood. So the support letters in the kind of equity and debt commitment, those can be kind of, and often what we see is that those are conditional on the grant fundings. That so that basically the equity funders of the project say that we are willing to finance this case according to these kind of business case numbers that we are presenting to the SINEA in case we receive the funding. So basically the letters don't have to commit on funding an unprofitable project, but they have to commit to funding the project in case the grant is being received. If that answers your question.
No, that does. That's certainly different to how we understood it initially, so that's quite helpful.
Yep.
Okay, we'll go.
Yeah, I had a second question as well, which was specific to an application that we had, which, just to reiterate, or a product which has been introduced to the market due to specific technical requirements of the product created a cost for users. And so in order to make our product competitive in the market, we adopted an approach which had a discount to the, I suppose, the reference price in the financial calculator.
Yeah.
The feedback we got from that was mixed in terms of our assessment, and I'm just wondering if there's any thoughts on that as to how we could incorporate that going forward.
Okay, so if I understood correctly, the question is that you had a product that you had a reference price from the market on, but you decided that to make it kind of competitive, you didn't sell it at the reference price, but you sold it at a lower price.
Yeah, exactly. So effectively, our customers were cost neutral. So what it looked like in the financial information file was actually a negative green premium, which seems unusual, but from a commercial perspective is how we would operate.
Yeah. I have not really seen in the previous applications cases where the green premium applied in the application would be negative. So it's a bit hard to comment on like a specific example like that. Apologies for it.
Understood. That's the feedback we got as well.
Yeah.
It probably goes to the strength of the justification that you provide in support of it, right? Which is subjective, but to the extent that you can point to, or validate the commercial rationale behind it, I think it might serve for a better evaluation. But it is fairly subjective, I'd say. Yeah.
I think we might shorten lunch a bit, and we'll crack on with questions if that's all right, because I think this is the best use of our time. So next one, Slido. Are most applicants asking for maximum 60%, or is it often less?
It is often less. I don't have the exact statistics right now in front of me, but the Innovation Fund publishes dashboard on the applications that basically showcase the GHG savings as well as the grant awarded, and based on the numbers in the dashboard, it's possible to kind of roughly estimate on how many applicants are applying for less and how many are applying for more. But I guess that generally speaking, like the large projects which have very significant GHG savings and score very high in the cost efficiency ratio, even when applying for the full amount, those projects often can apply for the maximum 60%. And then projects with like probably a little bit problems in the GHG savings, not having as significant savings as some larger ones, they may be applying for less for strategic reasons.
Thank you. What are the best practices for the Excel budget table to capture phased capex in Irish renewables? And that's to take into consideration the grid connection delays, contingency for marine consents, etc.
Oh, that's quite a specific question. So I think the
Miko,
general
maybe it's something you want to come back on later and we'll be able to give a response. Yeah, because it is
sure.
specific. So whoever asked that, we will get back to you. Just maybe give us a chance to ponder. Next question, and just a reminder, anyone online, you can also put things in chat or raise your hand and ask in the room. For a RES project, how do we validate revenue assumptions in the financial model, and which sensitivity scenarios strengthen evaluator confidence?
So I guess that generally speaking, if we are looking at RES projects, we are referring to like what electricity prices are we using in the forecasts. And I suppose that generally speaking, if there is an external like market report from market evaluator, market forecaster, you know, the likes of like Baring or Aurora or whoever are giving those forecasts, that would be probably kind of most reasonable support for the electricity prices.
Thank you. As innovation in Ireland is behind what is considered innovation in Europe, is there a list of measures that are defined as non-innovative? Well, I know anyway, depending on the call you'll be applying for, if you're going for the small scale call, for example, the project only has to be innovative within Ireland, not across Europe. That then increases if you go for the medium or the large scale. So a small scale call is up to 20 million, and that can just be innovative in Ireland. I don't know if you want anything to add.
I think the definition of what's innovation or what's innovative is again subjective. You know, you then look at criteria such as TRL and the importance of measuring against state of the art. What's been done before? Is it incremental? What's the extent to which you're advancing the technology versus this being a sort of an incremental play? All of those are sort of decision criteria to help gauge how innovative your project is. But I think you know, that state of the art analysis is critical as part of that.
Thanks. How does co-funding from member states work, and how is it reflected in the application?
Yeah, so any co-funding has to be kind of clearly stated what are the sources of funds for the project and where does the money come in from. And there are specific places in, for example, the financial information file where you would be defining or putting in the numbers for any other grants or subsidies besides the innovation fund.
Thanks. I see the other two questions are regarding the greenhouse gas, and we'll be dealing with those after lunch. And if you've got questions regarding that, you can put them in Slido at any stage. So before I take a break, just last call, see if there's any more questions in the room. No. Well, I suggest we come back at 12:15 for the second part, and enjoy your teas and coffees, and we'll see everyone online soon. Thank you.
Thanks.
So, Miko, if you just want to start again whenever you're ready.
Absolutely. Let me take over the screen. So for this part of the for the session, we are looking at like EY's take on what the applicant's detailed financial model could look like and how the numbers from this would then be interlinking between the financial information file. So I'll just quickly showcase like how we tend to construct these, and then we can move on to how the numbers from this file then would be flowing into the financial information file template provided by the EU. So in our modeling way, we basically have like 3 different sections in the models, one of which would be the kind of outputs. Second of all would be inputs, and then we would have the calculations. Then in the model we also have certain support sheets, but probably given the time is limited, I won't go into too much details on the modeling logic. But the way we are used to doing it is that we would have like a constant input sheet, which would be kind of our way of doing the scenario analysis, as well as discussed in the previous session. We feel that it's extremely important to also kind of being able to analyze various different scenarios around the projects as well. And I have predefined like 4 different scenarios here as a kind of showcasing examples of how different kind of assumptions around operations would impact your financial numbers of the project. So basically our scenario manager would then be selecting the numbers to column F based on the selected whichever scenario we have active, and then those numbers would be flowing through to the calculation sheets. Our example project here.
Sorry to interrupt, Mikko. Could you zoom in a little bit, please?
Absolutely.
Thanks.
And our example project here is basically like we could imagine that this is like a project producing heat for a district heating network. And for the production side, we have therefore defined what is the total capacity of the project in terms of megawatts, what is the annual generation. Then we may have like varying generation figures depending obviously on what the project type is. Sometimes the generation is quite fixed number, but sometimes there's variance if we talk about, for example, renewable energy projects. So this section is basically defining the numbers of the production or the operational numbers of the projects. Then we have defined certain sales price, which is selected as a drop-down selector from various alternatives that we are defining on annual time-based input sheets. So here we have defined like a couple of prices. First of all, what would be the heat sales price and what would be the electricity sales price. And the selections that we make on our input sheet here are then flowing through to the calculations. So basically we are just selecting which one of these sales price profiles are we using. From OPEX side, we have done it so that there is basically different drivers on the numbers here. One driver could be megawatts of the project, one could be megawatt hours of heat or electricity or whatever produced. And we recommend doing it so that basically kind of you have possibility to define like on a line item level what the costs are related to, since kind of the evidence that we provide as supporting evidence to the innovation fund should be kind of on a quite detailed level. Then we have certain assumptions on the FTEs, number of employees, cost per employee, electricity consumption, etc., etc. Then another important section, I think, is the financing part. So here we are defining what's the grant amount, how it's being paid out. So as discussed earlier, at least 10% of the grant has to be paid during operations and 90% during construction period. So we have defined it that way. And then on the other financing side, we have a certain example of a senior loan, which would be amounting to 30 million in the base case, and then the remainder of the capex would be then funded by either equity shareholder loan or then the innovation fund grants. But probably not useful to go into too much details on kind of the model logic itself, but maybe what we would be interested in this context would be the outputs, sensitivities, and how the outputs are then reflected in the financial information file. So first of all, due to any input assumptions that we define on all of these kind of different sheets, we are then flowing them through the calculation sheets, and as the standard first output that we are looking at would basically be the financial statements of the project, and that's very important output also for the financial information file template. So what we are separating here is then like total revenue of the project, in this example generated by heat sold, how much grant we would be receiving during the operational period, that's recognized part of the revenue, and then operating expenses split into adequate level. So on example, we have like quite high level split on the OPEX side, but the more granularity and the more details you can provide about any cost assumptions and detail them, the better. Then we are looking at depreciation of the CapEx, generating EBIT, any interest expenses on the loan that we are expecting to raise as part of the construction period, and then taxes, etc. Then we have very simplified balance sheet here. The outputs of this balance sheet section also go or are reflected directly in the financial information file, and then final part of the kind of key output or the annual financial statement output is then the kind of cash flow statement and sources and uses of funds. So basically here we are interested in addition to kind of the EBITDA generation of the company on where the money is coming in from and where the money is used. So separating between actual construction CapEx and maintenance CapEx, that's important given the different treatment in the relevant cost calculation, and then kind of how the CapEx is funded. So here we have grant received, senior loan, SHL drawdowns, equity injections, etc., etc. Then maybe looking at the dashboard, this is probably like quite interesting to have a look at. And when I was mentioning during the previous session about the kind of sensitivity and scenario analysis, we have I prepared a couple of different alternative scenarios here. So in this particular example, illustrative base case, we can have a look at a couple of those graphs. So first of all, we were talking about the kind of optimal relationship between project IRR and weighted average cost of capital. So in this instance, we are basically calculating different project IRRs. The gray curve here showcases the project IRR before grant. Blue line here showcases the project IRR development post grant. And now we are in a situation where the cost of capital for the project would be 7.5%, pre-grant IRR 5.8, and post-grant IRR 9.0. So basically, we are in an optimal situation where the receiving the grant basically makes the difference in the project's profitability from our perspective. Then the second graph that's probably interesting to have a look at a little bit of sensitivities about is the cost efficiency and maximum grant. So what we are plotting here is the cost efficiency scoring line, which is this blue line. Then black line is the kind of active case of grant requested, which I have defined here for illustrative purposes as 25 million. And this gray line is then describing the maximum grant possible to be drawn down based on the relevant cost calculations, which is 31.9. And we are seeing that, okay, in our base case, everything looks fine. But what if we are starting to edit our numbers slightly? Let's say that our project CapEx would, for some reason, be 10% higher than what we are expecting. What would happen to the numbers? And I would draw down the attention basically here. So right now, if we are looking at the project IRR in a scenario where our CapEx costs increased by 10%, which is not really like a super drastic change in CapEx for these types of construction projects, our case would actually turn around slightly, where our project WACC still remains at roughly 7.5. Well, actually, it has altered slightly because the funding structure also now changes. But anyway, the key message here is that even a slightly small change in our project assumptions lead to a situation where the project NPV is no longer positive when calculated according to the Innovation Fund guidelines. So these kind of sensitivities need to be considered in the application, and if the project happens to be super sensitive to small changes in the assumptions, you need to be kind of able to showcase commitment regardless of that. And then maybe this cost efficiency graph is another thing that I would like to draw your attention to. So right now we have used an assumption that the project is applying for 25 million of grant funding, and the absolute GHG emission avoidance is 750,000 tons of CO2. And based on these numbers, we would get to a cost efficiency score of 10. But what would then happen if we would, let's say that we would want to draw down the maximum of around 31 million euros of grants? So we would have to increase our applied grant for approximately 6 million. And then looking at this graph, we see that, okay, our maximum grant and requested grant are almost on top of each other, but the CER has decreased. Okay, but what if at the same time we realize that, okay, we have made a mistake in the GHG savings calculations originally, or we missed something there, and actually we can increase our GHG savings by 33%. So we would have a total GHG emission avoidance of 1 million. And therefore, kind of this graph, this maximum grant or CER scoring line changes, and again our scoring on the CER ratio would change accordingly. And you can also see how it impacts in the kind of project profitability and like relationship between the IRR and weighted average cost of capital calculations. So these types of sensitivities are, based on our experience, quite useful when you are thinking about your project and the optimal grant funding amount, etc., etc. Also, it's interesting to look at how the debt funding impacts the numbers. So right now we have debt funding, let's see, 30 million of loan out of total of almost 90 million of sources of funds. What if we would increase the funding of debt by 10 million and see what happens in the numbers? So our cost of capital decreases, and at the same time you saw that the kind of maximum grant number changed slightly given the weighted average cost of capital has changed. And at the same time, like the project profitability numbers change quite significantly. And maybe if at the same time we would say that, okay, our interest rate would be 3% higher, you see that everything impacts everything. So at the same time, our maximum grant line increases, but on the other hand, our kind of project cost of capital increases as well, which means that we could be eligible to apply for more funding, but then there's a question whether our kind of project IRR is like keeps to the competitive levels anymore. And this particular example that I have in place here is assuming kind of a project with relatively high capex and low opex, meaning that it has a high EBITDA margin and high capex in comparison to kind of the operating expenditures. And this leads us in a situation where the pre-grant IRR is 5.8% and post-grant IRR is 8.3%. But maybe good to have another example case as well. I've defined a case here where there is a lower capex and higher opex, but in a way that the pre-grant IRR remains constant at 5.8%. But we can see that kind of our project IRR has significantly increased when we are moving our costs from upfront capex costs to like opex costs, which are then discounted. And what has happened in the cost efficiency chart at the same time is that the maximum grant amount has suddenly dropped from roughly 32 million to roughly 17 million. So this is probably something also that's good to keep in mind when analyzing the projects and thinking about. There may sometimes be like make or buy decisions in these projects as well. For example, if we need like hydrogen in some of our industrial processes, there could be a question whether we want to purchase the hydrogen from external provider or whether we would want to build an electrolyzer as part of our projects. And that would potentially, in some cases, completely shift the numbers in the cost efficiencies and maximum grant applicable, given that any OPEX costs are discounted and CAPEX costs are taken at face value. So generally speaking, obviously this all has to be kind of evaluated as an overall context. But generally speaking, your maximum applicable grant is normally higher when you are trying to get all the potential costs upfront or trying to argue kind of high CAPEX costs. But yeah.
Mikko, I think we've lost your sound again there.
Can you hear me now? I'm sorry about this. The headset is...
Yeah, we can hear you.
Yeah, sorry about it. But yeah, I was saying that the next we're going to have a look at the interlink between this like applicant's detailed financial model and the financial information file. But and I was saying that both of these are mandatory appendices. I think we mentioned it already, but anyway, so the file I'm showing right now is like the applicant's detailed financial model, where it's important to have all the sensitivity analysis and all the scenario analysis, but the case that we are showing in the financial information file and the case that we are presenting to the EU, that has to be only one scenario, obviously with sensitivity analysis included, but having these kind of functionalities in your model where we can select from different scenarios and do some quick operational sensitivities often help us with understanding and creating kind of the risk analysis also in the application documents.
Mikko, sorry,
Yep.
another question from my side. Obviously, there's a balance here to be struck between the amount of grant requested and the cost efficiency ratio.
Yep.
Can you comment on, the thought process around how you decide what that sweet spot is? Because do you build a model and hold true to the model and hope that it lands well with an evaluator, or do you step outside the model and say, okay, well, based on experience and based on prior applications, etc., and where prior applications have landed, let's adjust it so to a different place, i.e. lower the grant request amount in order to score higher on the CER because you think it'll land better with evaluators. What's the kind of the thought process around that?
Yeah. So basically in the innovation fund application, everything is more or less interlinked. So when we are thinking about, do we want to apply for the maximum or do we want to reduce a little bit? Maybe the first thing to think about is in the last slide of the previous session that I showed is that we have data available on the CER ratios of the successful projects. And I think that the median was around 11. So that's the starting point probably in thinking about this. But then on the other hand, if we know that our project is truly one of a kind and extremely innovative projects, and we know that we are scoring high on the degree of innovation, and also if we are aware that okay, actually our technical maturity is state of the art, we know that this project works, we have due diligence reports available, and it's proven concepts, and we are expecting to receive high scores in other areas of the application. Then we could actually think that, okay, we probably don't need the 11 points in cost efficiency to be competitive, but we can do with 10 or even 9, obviously depending on the limit set by the maximum grant. So it's kind of a comprehensive process of assessing previous experience, assessing the existing project against its competitors, etc. So there's no like a definite answer to be given on that, but it's kind of assessing the application as a whole is kind of important in this context. All right. Maybe on the output sheet. So what we like to do is generate a separate output sheet which is consistent with how the financial information file looks like. So this is all just kind of call-ups and references to other parts of the model, and we have structured this sheet so that it's almost exactly the same as the financial information file template. And we can easily copy paste all the numbers from this particular sheet to the financial information file. Probably no need to go through kind of our take on the detailed financial model further, but we can then have a look at how these numbers would then flow into the actual financial information file. So this is basically a sheet that looks exactly the same as the FIF template. And I'll go to another model now. So what we see on the screen right now is the financial information file from the latest call. So I have basically filled this in based on the numbers that we saw on the previous page, and the main input sheet is this particular one, Fin model summary inputs. And as said, basically section 2 reflects the timing up until here. So there is the project starting date, financial close, construction period, entry into operations, and total project lifetime, and also the innovation fund project duration, which basically starts from the project start date and ends when first 10 years of operations have occurred. Then we are defining the WACC. Probably no reason to go into details on that anymore. We covered that earlier as well. Then the funding sources. So this has to be corresponding to whatever we show in our own detailed financial model. So how much grant we are expecting to get during the construction period. This is important. This only reflects the grant during the construction period, and reminding you that 10% of the total grant has to be always allocated for the operational period. So if we are saying that we are applying for 25 million of grant, maximum that we can get during the construction period is 22.5, and the remainder has to be then drawn down during the operational period. And maybe from the funding sources side, good to also remind you again how this kind of equity and debt ratios are determined. So we cannot consider this particular line or the other subsidies lines when defining the equity ratio of the project, but it has to only consider kind of actual equity and shareholder loan from the project shareholders, and reminding again that shareholder loan is treated as equity, and then debt. And these values are basically calculated on the basis of the values that we input here. Then we put the GHG emission avoidance. Rita will cover this a bit later, so not going into details here. And the numbers that we are using here are basically just very illustrative figures, not really describing any real life case as such. Then the revenue side. There are 5 different sections if there are different products that the project is selling. In our example case, we have only filled in one of these, and basically it's then being divided between volumes and prices, where the prices are then defined as the market price of closest substitute plus green premium, and as heard previously, it can also be negative, but usually what we've seen is that the green premium is intended to be a positive number, and maybe an example of what could cause this is maybe from, let's say, metals manufacturing industry, from, for example, steel, where we may have a market price for steel produced at the conventional technologies, but purchaser may be kind of able to pay premium prices if they get green steel. And whatever numbers we have here, we need to be able to support them somehow. And maybe on the market price that we have defined here, you see that it's increasing, and reminding you again that we can use justified inflation assumptions in the numbers. If there are any byproducts such as CO2 or anything like that, that should be separately covered in the calculations, and also emission allowances shall be separately covered if you are operating in a industry which receives the ETS allowances. Innovation Fund grant. This is input on a separate sheet, and this is just flowing through the kind of summary input sheet. So the grant breakdown is on section 4 here, and that needs to be filled in based on so-called work packages. And those work packages are defined in other parts of the applications, but basically anything that we input here with regards to the grant drawdowns, those have to be consistent with activities and costs arising during the particular work package. So, for example, if up to financial close, we say that we would be drawing down 6.2 million, we need to be able to showcase that we actually need the money to cover certain costs during that phase. And that's the reason why in many instances, the majority of the grant is drawn down during the construction period, because that's when the major cash outflows also happen. And then, as said already many times, the after entry into operations, we need to be drawing down 10% of the grant. So here we are basically saying that during the first 10 operational years, we are drawing it down equally. Then we have separately cost of goods sold, which is driven by similar units as the sales prices. So for each of the revenue sources that we define, we have cost of goods sold. And in this particular example, if we are, let's say that we are generating heat from some electricity-based solution, well, our cost of goods sold here would then basically be the electricity purchases. And similarly, there could be reasons why the prices of the input are going or adjusted based on different inflation or adjusted based on different percentual growth assumptions when compared to the revenues. And if we use such assumptions, for example, here we have a declining curve for the prices in the first years, that also has to be supported somehow. And when it comes to, for example, electricity, any external market reports and such could be good supporting evidence. Then other OPEX is separately inputted, depreciation and amortization. This is something that we recommend calculating quite in a quite detailed manner in your own financial model based on like local depreciation rules and the nature of the assets that you are investing in. So financial information file does not separately calculate anything here. This is just inputs. And whatever we have as inputs, or for example on depreciation, it's good if they are actually based on the local rules, that we are using kind of actual depreciation periods for the assets that we are investing in. Then from accounting perspective, the grants received during construction are netted out from the depreciation. So what we are showing in the P&L as total is kind of the D&A after reducing for the Innovation Fund grant received for the construction. Then we have interest expenses, and then we have tax. For tax, maybe one specific point. They are mentioning here that if there are tax savings where we use positive numbers here, that has to be justified in the application form. So basically, if we would make negative profit during the first operating years, it could be the case that we are showing positive tax numbers here. But our preferred approach and what we usually use is that we are looking at how much historical losses we are making and then kind of calculating taxes only after deducting for the potential historical tax losses, because it's not like if we would show positive taxes on the P&L, I think that it would be a bit unintuitive mostly. Then cash flow statement is inputted separately. And maybe from the CapEx side, this is also a case where data is inputted into a separate sheet called CapEx inputs, and CapEx is the only input sheet here where the numbers are on a quarterly basis. So good to keep in mind that the timeline is different on the CapEx input sheet when compared to the financial model summary input sheet. So here we have annual timeline, whereas in the CapEx inputs we have quarterly timeline. And anything that we put to the CapEx sheet here is then just being kind of summed up to the annual timeline on the sheet number 1. All right, then other cash flow items. So the funding, equity raise, debt issues, dividends, SHL interest, as well as senior debt repayments and interests are inputted here. And similarly to the other sections, these are just hard-coded numbers, and we recommend that the kind of applicant's own detailed financial model is constructed in a way that the kind of interests are calculated correctly and repayments are calculated according to the debt terms and expected tenor, etc., etc. So whatever we have here, it just has to correspond to the numbers in the applicant's own detailed model, but the actual calculations are performed outside of this file. And then the last input that we have would be the balance sheet numbers as presented on the financial file template already. I think that I'm running out of time, so just looking quickly at the output sheets and then we can go back to the questions. So this output sheet is more or less the same as we had in the our own model template. It's just showing the financial statements, P&L, balance sheet, and cash flow. Then the IRR analysis here, it's calculated according to the innovation fund template, and they are making certain simplifications and certain assumptions here, which often leads to situations that if we would calculate kind of post-tax IRRs or unlevered IRRs in a specific manner in our own model, for example, we could have situations where tax depreciations and accounting depreciations are different, leading to differences in tax payments. That would lead to a difference in project IRRs calculated in our own models and in this template. So like my first recommendation would be to adjust the formulas in your own detailed financial models to correspond to whatever happens here, just to avoid any unnecessary explanations having to be made in other parts of the application document, because the numbers may seem a little bit off if the IRRs, for example, are different, even though there would be a reasonable and rational explanation to that. But generally speaking, it's probably better to show consistent numbers between the files. Then we have the relevant cost calculation, and here we have the difference between the no reference plant methodology and the reference plant methodology. So relevant cost calculation is actually quite simple, especially in the no reference plant methodology. We are just taking the numbers for CapEx, maintenance CapEx, OpEx, revenues, and discounting this to present value and calculating the sum. So that's basically the relevant cost number that we have here is just calculated as the sum of these rows above. And good always to make sure that the numbers that you have here match whatever you have calculated internally in the other model. But then if we go to using the reference plant methodology, first of all, we need to select on the summary sheet inputs which method we use. And here we would want to use the reference plant methodology. And then the calculation on this sheet would be actually a little bit different. And the way this is calculated is that we are taking basically the numbers that we have according to the no reference plant methodology, which is the standard methodology. And then we need to define in the RC input sheet a separate business case for the so-called reference plant, which would be a plant doing similar end product, similar products, but without the innovative angle. And this is much more cumbersome and much more time consuming and needs more supporting evidence because in the standard methodology, we only need to provide the evidence for the kind of assumptions taken for our innovative project. But if we would want to use the reference plant methodology, we would have to separately define cost of capital for the reference plant, and we would have to define revenues, CapEx, OpEx, and maintenance CapEx for the reference plant. And all of these assumptions then would need some additional support. And it's like the application process itself is already kind of time consuming and needs a lot of evidence. So my recommendation is that if you can avoid it, and in, well, practically or all circumstances you can, then I would not go with the reference plant methodology. It's much more complex. All right, then the other sheets, this is just the cost efficiency ratio, simply calculated as the ratio between the requested grant and other funding and the CO2 savings. Summary chart sheet, this is more or less similar as to the dashboard that we had in our own internal model that I showed you. Basically, this is summarizing everything and
Lost you there again, Mikko.
Miko, if you can hear, we've lost you.
Okay, maybe I'm back again.
You are, yeah.
I'm really sorry. I don't know why my headset keeps doing this, but I was anyway kind of concluding the session and asking whether there are any additional questions.
Yeah, just thanks, Miko. So, well, nothing like a financial information file to generate some appetite for lunch, right? Given the iterative approach that has to be taken here to build the model and all of the necessary inputs, etc., is there any tips or advice you can offer as to how that process can be broken down or simplified, made more practical? Do you go after a subset of inputs, finalize that, move to the next set of inputs? Just some practical tips in terms of how to go about building that model.
Yeah, maybe first of all, based on experience, it's quite important to start gathering the inputs and the evidence like very, very early on in the process, when we need like for some of the LOIs and MOUs and stuff like that, we usually need like signatures from the counterparties, and sometimes it may be time consuming to have the wording in those documents to be like approvable for all parties, and signing them may take time, and we don't want to wait for the kind of 1st of April to start getting these documents together, because it's not going to happen. So we first of all recommend to kind of start gathering the evidence very early. Then maybe second point is that usually kind of we start with the easy input assumptions, or the easy assumptions where there already is some document and support available, and we look at the business case on kind of in a way that, okay, these assumptions we can deem fixed already at this moment, and then kind of we would focus on the more difficult assumptions, or the ones that have the most uncertainty in them, like mostly in the process. That's maybe my first tip, but it's time consuming, and it's usually like a balancing game between what we can actually receive and how we kind of frame it in the application.
Perfect. We'll start with Slido, and if anyone in the room has a question, please raise your hand and Gary will be over at the mic. So the first one, should phased grid connection costs and CapEx be front-loaded or spread over a 10-year rail costs period to optimize the euro to avoided score?
Okay, so the CapEx costs themselves do not impact the euros to CO2 avoided score. So only thing that impacts the this cost efficiency score is the amount of grant you request and the tons of CO2 avoided. But the CapEx timing and front loading does impact the maximum grant that you are able to get. So it does impact the relevant costs, and generally speaking, the more costs that we have upfront, the more cost that we can have front loaded, the higher our relevant cost will be. But this has to always be analyzed in connection with the project IRR, because if we front load our costs, it also means that our project IRR will be lower. And even though that could increase our maximum grant, but it could also reduce our project NPV to be below cost of capital. So everything needs to be analyzed in connection with each other.
Thank you. Any questions in the room? Yep, one here.
Hi, just a question on the contingency. Is there, in your opinion or your experience, an average acceptable level of contingency, A, and B, is the contingency a category of spend that could be used to influence getting that sweet spot?
It's hard to say whether there is an acceptable level. It needs to be based on normally if we have used some contingency assumptions, there is like a technical consultant or someone who says that in their view it's likely that there will be this level of uncertainty in the costs. Maybe to the other part of the question, I would perhaps not optimize the application when it comes to kind of the level of contingency used, because there will be an audit of the relevant costs shortly before entry into operations, and in that audit basically there will be an external party looking at the assumptions that you have taken in the application process. And if those assumptions have changed significantly, such that your project actually, when it enters operations, is much more profitable than anticipated during the application phase, then the amount of grant could be reduced. So that's also a reason why everything that you put in the model in the application phase that has to, or it's recommended to be like as close to reality as possible to avoid also having to reduce the grant later.
Perfect. We'll go back to Slido. What sensitivity analysis on key CER drivers must we include in the financial file to defend our ratio against SENEA's benchmarks?
The sensitivity analysis that's included, it's not like strictly speaking defined, but it's dependent on the projects, obviously. But what I would kind of generally speaking sensitize is capex costs, pricing assumptions. Obviously, capacity factor is one good thing. Discount rate, debt terms. Just trying to identify what is the most influential factor in your project. That's important, and then showcasing the sensitivities around those. I don't think that there's a general guidance on what factors to be sensitized because they are so project specific.
I think we've lost sound again. Nico?
Okay, let me try to.
Yeah, we can hear you there.
I'll try to get a wired connection because this is quite annoying.
No problem. Whilst you're doing that, we can look at this next question anyway. We can answer. Is there a risk to the grant funding post-award if the assumptions made in the financial file are incorrect due to external factors, example, geopolitical events? So obviously, you should try and be as accurate as possible. There is some leeway either side for you to go up or down, and there is a mechanism, force majeure, for sort of example before on other grants would have been COVID, like no one saw that coming and it had an effect. They're quite stringent, whilst they're quite agile with their criteria and sort of topics they'll look at. The need to meet milestones and financial close is strict, but there are different scenarios where there can be some leniency. The next one then, and hopefully we'll have Mikko back. In the heat auction, can the OPEX support turn out to be greater than 100% of the CapEx?
That's actually a good question. And to be clear, I mean, these similar files are not part of the heat auction. So the heat auction is actually a bit more simplified process. And also good to keep in mind that the heat auction is organized in the first time, like at this particular call, and it's not really measured against capex per se, but basically only the efficiency when it comes to kind of cost efficiency when it comes to euros requested per CO2 savings is the driving factor there. So I guess that theoretically speaking, the support could be greater than CapEx, but I really doubt that in real life that probably would not be the case, especially in successful applications.
Thanks. Yeah, so the heat auction is new this year. They launched it at dramatic speed and developed it, in quite a short time. It is an exciting sort of adventure, and I think many Irish companies can take advantage of it. It is based, but should be an improvement on what was and still is the hydrogen auction. So I think people should look at that to see where the heat auction may be going, and obviously we'll know more, and there'll be further discussions at the EU Info Day in December. Any questions in the room? Yeah.
So normal projects would be, the applicant, they're bought into it financially, and the environmental impact will happen at the site of the applicant. So just being mindful for other projects where it's heat as a service, so the environmental impact might not happen at the applicant's operations. It's where they're providing the heat to. Is there anything within all of this to be extra mindful of? I know with state aid there can be limitations for passed on incentives, that you have to be incentivizing the entity that is purchasing the capital, investing in the project, and bears the cost of the operation, of the increased operational costs. So bit of a messy territory maybe, or maybe there's a simple answer to it.
Yeah, I'll let you go ahead because I don't have an answer for that one. I'm hoping to learn more next month.
Yeah, unfortunately, I don't have an answer either. It's at least something that's not really reflected directly in the financial files.
Nothing of particular value to add to that either. I mean, there's obviously examples of deployment in other jurisdictions. So, like your question is very valid in the context of state aid rules. How it maps into the constraints of the Innovation Fund, I think we should take that one and come back to it, actually, because it is very pertinent, particularly for businesses who have operations in different jurisdictions and who may be faced with a decision actually as to whether we drive this through our Irish subsidy or another, subsidy in a different jurisdiction. So I think maybe that's a follow-up.
Yeah, perfect. And of course, if there's anyone has any questions afterwards, please email the innovation mailbox, and we can answer them directly, or go to Sinea on your behalf and do get the answers. As I said, that heat auction, it's the first one running this year. I'm hoping, I'm sure they'll do quite an intensive session on it in the information day in December. But we will stop for lunch, and if everyone can be back for 2 o'clock sharp, anyone in the room, there's a lunch just outside, and please take that time to network, and everyone online, we shall see you at 2 o'clock. Thank you. Hi all, welcome back after lunch. So I think we were all deep in conversation there. I didn't even realize the time myself. We've dealt with the financial, and now for the bit where I know the majority of people have come for, the greenhouse gas calculations. So these tend to be the questions we receive the most as the national contact point. We have been told that the new template that was introduced last year is to make things easier, but I don't know if anyone's applied recently, if they would fully agree with that. So I'm delighted to welcome Rita from EY to go through the greenhouse gas calculations. And just remind everyone as well, you have Slido to put your questions in. There's some there already, and we'll try to get to as many as we can. And you can also ask online and in the room. Thanks, Rita. Good luck.
Thank you. So as was mentioned, I'm sorry, I'm going to talk about the GHG emission avoidance calculation, and I'm going to go through some use case examples as well that we have some experience. So just to give you an overview of our agenda today, we're going to start very quickly going through why is the GHG calculation so important in Innovation Fund. Then we're going to go step by step on a successful calculation of the greenhouse gas emission avoidance. And we will discuss three sectors, the three main sectors for the call, which is the energy intensive industries, renewable energy and energy storage, and mobility. This last year, we also had a building sector, but it had very few applications, and so we're not going to discuss very much into it. And also the methodology follows the same methodology as applied for other sectors. We will show you two case studies, one for energy intensive industries and one for renewable energy, walking through a geothermal power plant. So that will come a little bit later. I will introduce this just saying that this is quite an extensive topic. So the methodology, as you probably know, is upwards of 190 pages. And obviously, it's impossible to cover 190 pages in a 2-hour session. So we will discuss the most important aspects. We will discuss some common pitfalls, and also going through what are the usual steps for a calculation, and then we'll answer your questions that you have regarding your specific cases. So jumping right in it, why is the GHG calculation so important in Innovation Fund? As Miko and Ross talked about earlier in the session, the proposals are evaluated in a cascaded approach. So first is degree of innovation. If a proposal does not meet the minimum for degree of innovation, it stops. The second thing it's evaluated is the GHG emission avoidance potential. So if your proposal does not meet the minimum pass score of 3 for GHG, then evaluation stops. What does this mean? The GHG emission avoidance is evaluated in these 3 to 4 criteria. So the absolute GHG emission avoidance, which is from 0 to 2 points. This is the actual absolute number that we're avoiding. So let's say 100 kilotons of CO2 equivalent we're avoiding. This is from 0 to 2 points, but it's actually evaluated twice. It's double counted because this is the number that we're going to use for the CER that we mentioned earlier. So the cost efficiency ratio. This is the number that we're going to use. It's the grant divided by this number. Then we have the relative GHG emission avoidance. This is the ratio between the avoided emissions and the emissions in the reference scenario, our baseline. This is evaluated from 0 to 5 points, but we need to have at least a 50% emission reduction. So if you only reduce 49%, then we don't have enough emission avoidance to apply or to be evaluated. The next point, so the next criterion, which is the quality of the calculation, this is where most projects will fail. Because this is a qualitative, as the name indicates, a qualitative criterion, and it consists on an expert analyzing the correctness and robustness of the application of the GHG methodology. If the methodology was correctly applied, if all the assumptions are duly justified, what are any hypotheses that we are presenting, and do they make sense? Do they not make sense? And finally, but not least important, the soundness of the data traceability section. We will have a slide just covering this, but data traceability is fundamental for Innovation Fund because this is an operational project. So we are going to fund a new, let's say, a new process that needs to then be traceable. The emissions from that process need to be traceable, and we need to highlight that at application stage.
So this is from 0 to 5 points with a minimum score of 3 points. If you score 2 in the quality of calculation, it's done. And finally, bonus points. This is net carbon removals, other GHG savings, use of electricity from additional renewable sources, and finally, for maritime sector only, the potential to decarbonize the maritime sector. And this is from 0 to 4 points, 1 point for each bonus point. So these are the evaluation criteria for the GHG calculation. We usually focus on the absolute GHG, the relative GHG, and if you do have it, bonus points, but we cannot ignore the quality of the calculation. So if you're doing an application and you are you know that an emission factor or that a calorific value for some reason is not the one that we are expected to see, you need to justify it. You need to justify, and find any inconsistencies in the calculation, any inconsistencies between the calculation and then the application or the relevant cost calculation. All of this goes to this criterion. And so it's very, very important that enough energy is put into the quality of calculation. So with this said, we're going to now go through what are the steps to a successful calculation. So what do we need to do to point by point be able to calculate the greenhouse gas emission avoidance? So first of all, we need to understand our project. What are we producing? What is our process? What are we replacing? This will allow us to then cover the reference scenario and the project scenario to select the correct category, to select the correct sector, all of these. Second point, after we have a good grasp of the project, we then classify the project in its sector and category and identify the correct methodology. Following this, we have what are the covered emissions. So we have, as you know, different greenhouse gases. Are we only talking about CO2? Are we talking about other greenhouse gases, and how do we cover them? And what are the boundaries of our project? Finally, we identify the reference scenario. This is our baseline where we go from. And last step, we calculate. So to understand our project, we have to actually ask ourselves a lot of questions to make sure that we define the project correctly and ensure that our product and our project strategy ensures accurate GHG emission avoidance calculation. So we're often focused on our own sectors, our own industry, the nature of our industry, and not focused on the actual nature of the project. You can have a project within an industry and they don't really marry. So the first question we have to ask is, what is our main product of the project? And do we have any non-principal products that result from this project? And if so, what are those? Does the project involve a process change or a replacement of the final product? So think of this as we're working on an already existing establishment and we're changing how the process exists, how the process occurs. What practice or product does the project replace? So yes, let's say our product is methanol, but is the methanol going to be used as fuel or as raw material for a chemical? This is the difference between what is our product and what our product replaces. And it goes hand in hand with the next question: what will be the product's final use and who will be our off-takers? And finally, who are the key parties involved in implementation? This all asking and answering these questions will allow us to have a better grasp, a better understanding of our project, and will then inform our project classification. So after we have a notion of the project, we focus on the project classification. As you know, projects are classified into categories and then into sectors. So We're going to talk about them a little bit in the next slide, but we have, as I mentioned earlier, energy-intensive industries, renewable energy, energy storage, mobility. These are the categories. Within each category, we have our sectors. We do not choose the category. We choose the product. Our product is what informs our sector and then our category. So we first identify the main aim of the project, and then once we define the main product, we go into the classification of the project. And I can give you an example here, that's point 6. So renewable heat production is a good example, can be classified under the energy intensive industry or renewable energy, depending on its final use. It's renewable heat, but when we're talking about process heat, then it is the former, so energy intensive industries. When we're talking about district heating, is the latter, so renewable energy. The same thing for that example that I gave you earlier with the methanol. Methanol will go probably in the energy intensive industry either way, but the sector will be different. So if it's used as a fuel, it will go into the refineries sector. If it's used as a chemical, it will be in the chemicals sector. Okay, so we can take a look at that in a minute, but that's just an overview. So here are the categories that we were discussing. Each of these categories is then divided into sectors. I've talked a bit about the energy intensive industries, but for the renewable energy, we have wind, solar, hydro, geothermal. These are different sectors. Energy storage is similar, and then we have the mobility, which is split as well. Critical considerations I highlighted here. Some projects may have more than one principal product. Okay, and in certain cases, these products can belong to different sectors or even different categories. When this happens, we're talking about hybrid projects. When we're talking about hybrid projects, we should focus for the methodology in the sector that best describes the project's purpose. Okay, the main aim of the innovation, for instance. And finally, circling back to the GHG emissions in buildings, the building sector, this calculation should follow the relevant methodology depending on the project type. So the building can have a project within building sector or category, I'm sorry, we can use the energy intensive methodology or the renewable energy methodology or the energy storage methodology, depending on the nature of the project. Okay. So now that we've classified our project, we know which sector sector and category it's within. We then go to the GHG covered emissions and boundaries of the project. So the greenhouse gas emissions covered are all of these here to your left, to your right. So carbon dioxide, methane, nitrous oxide, hydrofluorocarbons, perfluorocarbons, sulfur hexafluoride, and any of those listed in the Annex 2 of the EU ETS system directive. Okay. Usually, we will only see carbon dioxide, methane, and nitrous oxide. These are the most abundant. These are the ones that we will discuss more. So the most relevant emission sources are obviously the CO2 from process and from the combustion of fuels. CO2 from biogenic origin is not counted generally. We'll discuss it a bit in a minute. Methane and nitrous oxide emissions from the combustion of all types of fuels, including biomass-derived fuels, is accounted for. We should also account for fugitive emissions in carbon capture and storage project and geothermal power plants. There is usually always some leakage. This needs to be accounted, and any non-carbon dioxide climate impacts from the aviation and maritime sectors. We should, all the GHGs shall be converted into CO2 equivalent emissions based on the 100-year global warming potentials. So this is tabulated, and we should use that as our data source. And also, this is something that's important to cover as well. Most emission factors we'll discuss it again in a few minutes, but most emission factors that we need are already covered by the methodology. So in our Excel sheet, we have emission factors, whether they come from the EU ETS benchmarks or from IF methodology itself. We usually have sources for most emissions. And here at the bottom, we have our calculation, basically. So how we calculate the absolute GHG emission avoidance and the relative emission avoidance. This is simple math. I'm sure everyone can follow this. But it's for the absolute, it's just the total emissions in the reference scenario subtracted to the emissions of the project and the carbon credit. The carbon capture credit, I'm sorry, the relative emissions, it's just this absolute GHG emission avoidance divided by the total emissions in the reference scenario. We use also a time frame of 10 years for the calculation of the GHG emission avoidance, 10 years of operation. So if you enter into operation in 2026, we calculate until 2036. These 10 years, and that's how we calculate the emission avoidance. If you have any ramp-up period, you should consider it, because then during the operation phase, you will have to monitor the emissions. And if you have a ramp-up period and you didn't consider it in your calculation, then you're probably going to be under what you estimated for the GHG emissions. Now, talking about the emission factors that I mentioned earlier, there are some emission factors which are already, there are many that are already established, but there are two main ones that are zero. That's electricity. Most cases, this is because Innovation Fund assumes that in a near future, all electricity within the European Union will be zero, will be from a renewable source. And then water. Water doesn't have any emissions, with the exception if you're using a pump or treating the water, then you should consider the water. And then the transport, we should only consider the emissions from the CO2, not any other GHGs, in carbon capture and storage or utilization projects. And for waste, when the transport is larger than 500 kilometers, okay? So anything below that, we don't need to consider that. Now, there are a few emission sources that can be excluded from the calculation. However, and this is a big however, we should always input them in the Excel file and put them to zero. So you cannot just discount them and not consider them in the Excel file, because you need to justify why they are zero. So electricity needs to be in the file, biogenic CO2 emissions need to be in the file. And those are the main two. Fugitive carbon and methane in geothermal wells are also excluded. End of life of the decommissioned machinery is excluded. Capital goods, construction, indirect land use change is also excluded. Extraction, processing, all the upstream emissions regarding fossil fuels, for instance, are excluded. So there are a few emission sources that are excluded from the calculation. So once we've covered this, we then identify the reference scenario. Our reference scenario considers let's say the conventional case. It's not always what your industry is already doing. You may be a little bit further in innovation than the conventional, but it is the conventional case that we must use unless there isn't any comparable scenario. Okay, if you have a comparable scenario to your project then you must use the conventional. So when applicable, we use EU ETS benchmarks as the reference scenario. If we don't have a direct product benchmark, then we combine the heat, the fuel, or the process sub-installations within an existing benchmark to create this reference scenario. So for projects introducing a modification to existing production systems, we should use the prior configuration of the process. So if we're changing, I can give here an example that I'm going to discuss a bit later, but a good example is a lime kiln, for instance, usually uses fossil fuel, so natural gas or fuel oil as their feedstock. If we are changing the fuel of a lime kiln, then we should use the prior configuration. So if you're using biomass, for instance, or waste, then we should use the prior configuration as the reference scenario. For projects producing fuels or natural gas substitutes, then the reference scenario is the Innovation Fund fossil fuel comparator. It's clear as day in the methodology, usually doesn't give us any doubts. For carbon capture, storage, and utilization projects, emission scenarios depend on the carbon source. So if it is DAC, so direct air capture, we don't have any emissions associated. If we have carbon or carbon dioxide capture outside the system boundary, then our emissions are the CO2 entering the boundary. We will cover this a little bit in the case study in a minute. If, like I mentioned earlier, no other cases applies, then the applicant, the company or the consortium proposes and justifies an appropriate scenario. This usually does not happen because to do your own reference scenario and for it to be accepted, you need to justify every comma, every value, every reason why, and usually at least a mix of the other possible options allows for a good reference scenario. This is one of the first things that the quality of calculation analyzes. So what was our choice for reference scenario? What is our main product? This is the first thing. So if your reference scenario doesn't make sense, the calculation is already doomed, basically. So the final step is the calculation itself. So we have to include the reference emissions, the project emission calculation, and the conversion factor identification if we need to identify any additional conversion factors. We do have default parameters, so the ETS benchmarks or the IF fossil fuel competitors, some net calorific values that we should use and that should remain constant throughout the project's duration. For hybrid projects, finally, different GHG calculators must be combined into a single file. So hybrid projects are quite complex because if you have two significant sectors, then you need to combine two different calculators into one single file, ensuring, and this is where a lot of hybrid projects have a problem, this is the main pitfall of a hybrid project, is that no emissions or no carbon credits are double counted. If it's double counted, again, quality is impaired. Okay, so as I mentioned earlier, we now have two case studies to go over, one for energy intensive industries and one for renewable energy. We will go, what I'm going to do is I'm going to cover the concepts of each sector or category, I'm sorry, and as we go through, I will explain the case study. So starting with energy intensive industries, this category covers projects that produce main products, replacing those whose conventional production is included in Annex 1 of the EU ETS directive. So this is the most abundant category. This is where most projects fall into. because you can see here the sectors covered in the energy intensive industry. We have refineries, iron and steel, non-ferrous metals, cement and lime, glass, pulp and paper, chemicals, hydrogen, and manufacturing of components for energy intensive or other. We have, I'm going to talk a bit about the other in a minute, but to be classified within the EII, the main product should either be or act as a replacement for a product that is under the scope of this annex. So in case of doubt, the sector should always be identified accordingly with the main product. I will give here a quick example regarding the choice of sector. We supported a pulp and paper industry project, one of the only industries which has a lime kiln, as I talked about earlier. So a lime kiln usually exists in a pulp and paper industry and in cement industry. And although the main product of the company, the pulp company, was pulp, wood pulp, the main product of the project was lime. It was not pulp. And so it was our selection of sector was cement and lime, and our product was lime, and then our category was energy intensive industries. This gives you an idea that your product doesn't have to be categorized in the sector you yourself fall into, right? So following through energy intensive industries, before we start identifying the emissions to be considered and the inputs, we need to identify our project boundaries, where our project starts and where our project ends, what we're going to cover within our calculation.
Excuse me, Rita, we have a question here on the floor. Just bear with me a sec.
Okay.
Very sorry to interrupt. On the ETS benchmarks, so a lot of our industries would maybe not have specific benchmarks, but they would be users of heat. In that case, do we use the benchmark for heat?
Yes.
Super, very clear. Thank you.
You're welcome. The system boundaries. We must define where our project ends and it begins. So we usually do this with a project diagram, which I'm going to show you as well in a minute. But our project must include the process emissions. This is where our boundary is. So where the innovation practices are being introduced. If any downstream processes are innovative, then we may include those. If our upstream processes are under our control, the control of our industry, then we must include those as well. But usually we include fuel combustion and the process itself. The input emissions are rarely within the project boundaries. So input emissions. We have energy and material inputs, so electricity, for instance, and any raw materials. As we covered earlier, electricity has an emission factor of 0. We still need to add its line. And then for the energy intensive industry, we have 4 types of inputs. We have rigid, elastic, semi-elastic, and de minimis inputs. A rigid input is the one that has the fixed supply. It cannot be increased to accommodate additional demand for our product. So these inputs are the ones that determine the amount of final product we can obtain. So circling back to that lime kiln scenario I mentioned, the project was replacing fossil fuel with biomass fuel. So we were using residual biomass from the production of wood pulp to fuel the kiln. This residual biomass was our rigid input because there isn't any more residual biomass than that is produced. So if we had 10,000 tons of residual biomass, that's what we were going to use. If another year we only had 5, then that's what it was. And that's a rigid input. You can't change it to accommodate changes in process. An elastic put is the opposite. So if we can increase or decrease the supply of this input in order to meet the change in demand, then that input is considered elastic. Water, electricity are obvious elastic inputs. And obviously, but they don't have emission factors, right? But this is easy to imagine. The emission factor is based on the emissions involved in supplying the extra quantity of that input. Semi-elastic inputs fall between both categories, so it depends case by case whether it is an elastic or a rigid. It can be both. And then finally, the de minimis inputs are elastic inputs, or inputs that you can buy more or less of depending on your need, but make such a small contribution to the overall emissions that they may be ignored when assessing emissions avoidance. So here falls electricity, here falls water, okay, elastic and de minimis. So process emissions, we here have fuel combustion. So this is CO2, methane, and nitrous oxide emissions from the combustion of our fuels. Other emissions within the system boundary. So even if it is a chemical emission of CO2, which happens a lot in the cement industry, then that should be considered as well. Transport emissions when applicable and when required. Any emission savings, any waste processing is also here. And then we have our other relevant emissions. The most relevant of these that I want to highlight is any non-principal products. So you need to identify your non-principal products from the start of your project and cover them in the reference scenario and then cover them in the project scenario, okay? Now, let's talk a bit about biogenic carbon. We can use biomass as a fuel. Biomass itself, we can use biofuel or other types of raw materials or fuels. And we can capture biogenic CO2. So we have these three scenarios right here. So biogenic carbon dioxide, should be treated as zero in both the processing and the combustion when we're talking about biomass and biofuel, so biomethane, all of these. We do not have an emission factor for biogenic carbon. You do need to consider, however, the non-carbon emissions. In case of carbon capture, biogenic is accounted for as non-biogenic carbon. There isn't a difference in treatment between biogenic and non-biogenic carbon dioxide for the capturing. It's the same, okay? So as we mentioned here in our third separator, carbon capture and utilization fuels produced using biogenic origin carbon dioxide are not to be considered biomass-derived fuels because biomass fuels are treated as zero carbon emissions, okay? And the final point is that non-CO2 GHG emissions must be included based on the relevant global warming potentials. So this is just highlighting what we already discussed. So the process emissions, what is covered within process emissions, what is covered within combustion emissions, and what is covered within end-of-life emissions. So I'm going to cover the example. I think it's easier to understand. So methanol, when combusted inside the project boundaries, that goes into process emissions. If methanol is the principal product and is sold to the fuel industry to then be used as fuel, then the combustion emissions go into project combustion. And if methanol is the main product but is sold to the chemical industry and not to the fuel industry, then it goes into end-of-life emissions. Okay? Final little highlight of the energy intensive industry before we go into the case study we have is the carbon capture. So very easy to follow carbon credit calculation. We have on one side the amount of carbon dioxide that is injected in permanent storage if we're talking about CCS, or incorporated into products if we're talking about CCU. This is the positive terms, and then in the negative terms, so the emissions arising from carbon capture. We have the emissions themselves from carbon capture. We have emissions from enhanced hydrocarbon recovery when and if applicable. We have emissions from injection and emissions from transportation of CO2 in pipelines or trucks, or all of this. So our credit we only have a credit when our positive outweighs our negative. Okay. And finally, we have our e-fuel production, which is within the sector and carbon capture. So this is a case of e-fuel. So we have all of our inputs here. At the left, we have steam, which is outside of our project boundaries. We have the flue gas from the carbon capture site. We have water, we have electricity, renewable electricity, and all of this, so the flue gas goes into the carbon capture and concentration unit, and our steam goes into our reactor. The carbon capture and concentration unit then separates the treated flue gas from the carbon dioxide, which is fed to our reactor. We also have an electrolyzer here at the bottom, which feeds hydrogen to the reactor. From this reactor, we have our syngas, and then another additional reactor, which we can split into e-crude or synthetic crude and waxes. So this is actually production of a zero carbon synthetic sustainable aviation fuel, or eSAF, based on green hydrogen and biogenic carbon dioxide capture from the flue gas stack of a biomass boiler. We have here all of the category, the sector, the main product, and the non-principal product. And so you can see step by step how we did this. This is a real project that we supported. Obviously, the numbers are illustrative, but the project itself is actually happened. So how do we define our reference scenario? So we have the synthetic crude production on one side, which is our main product, and we have our non-principal product, which is the wax. So for the crude, we use the fossil fuel comparator used for crude production, and then the emissions associated to paraffin wax used in wax production, that's what we used as our reference scenario. The next slide you'll be able to see. And then the project scenario, much more exhaustive. We have the electrolysis plant, the carbon capture plant, the reactors, and then any other emissions that we had, and the vehicle, so the combustion emissions from the crude, which we talked about earlier. So going over it again, electricity is zero. Always, so there's no really a problem. We did have emissions for the demineralized water because we had to demineralize it. So that's an additional step, and it's not normal, let's say, water. We also had NaOH consumption, which was our catalyst. And so that was also considered for the project emissions. You can see here, I hope you can see it. So the top table is our reference scenario. We only have the synthetic crude and the wax. We have the FFC, so the fossil fuel comparator. And then we have for 11,000 tons for crude, and we have here our total carbon dioxide equivalent, and then we have our wax here at the bottom. And we have as well our emissions. I'm not sure if you can see the bottom, which is the project emissions, but I can show you then afterwards the Excel file with it. We have all of these lines. So we have the electrolyzer, we have the carbon capture plant, we have both reactors. We then have the auxiliary equipment, we have the cooling water, we have all of these. We have the emission factors linked, And then we have the carbon capture credit. So we have the carbon captured for use, which was 650,000 tons of CO2 equivalent captured. And we we emitted about 110,000 tons of CO2 in this capturing. Right, that's in another sheet of the carbon capture of the calculator. And this is our summary sheet here for the e-fuel production. So we have our absolute GHG emissions here, GHG emission avoidance, which is 550,000 tons of CO2. We have our reference emissions, our project emissions, and then our carbon credit. So we have a relative GHG emission avoidance of over 100% because of our carbon capture. This is 132%, give or take. Okay, do we have any questions at this point? Perfect. Okay, so moving on to...
Sorry, Rita, hang on.
Yeah. Go ahead.
Hi, Rita. Sorry. Yeah, no, we have a couple of questions online, which we may just take now.
Okay.
If you don't mind. And we have a question. We'll start in the room with Keith there.
Just regarding the 100+% of carbon avoidance.
Yeah.
When it comes to the end of life for the CO2 in the fuel, is that taken into account anywhere?
The end of life for the CO2 in the fuel, we combust because it was a synthetic crude. The end of life emissions are the combustion emissions, if that makes sense.
But are they included then in the total avoided emissions, or is that accounted somewhere else?
Yes. I can try to show you my Excel so that you can see.
I just would have assumed that if the emissions were released at the end, then the carbon credit would be smaller from the carbon capture.
No, because whenever you can see my screen, please let me know.
Thank you.
So we are using the captured carbon and putting it in a reactor and producing the fuel, which will then be burned. And we also have the fuel is an example. We have the secondary product, which is the wax. So the fuel we have here, the combustion, and then we have the wax as well, the emissions from the wax. So these are, we don't need any additional end of life emissions because they're already here considering. If that makes sense.
Yeah, thank you.
Okay.
We may just take some of the questions that were just there on Slido. Yeah. Just Kieran, if you can take them now. Okay, so first one there. What are the common rejection pitfalls in greenhouse gas calculations for RES applicants' life cycle versus operational scope errors or curtailment assumptions? Can we mitigate?
Yeah, so most, I would have to do a deep dive into the RES applicants, and CNEA obviously does this a little bit, but most of the pitfalls in the GHG calculations are the same throughout. So what if the emissions were to be excluded or are included or vice versa? For instance, emissions due to leakage during the operational stage at a geothermal plant, this theoretically has to be included. If you forget to include it, or if you forget to justify why you're excluding it, this is a reason. So we need to have a robust justification for any deviations on the methodology. And most projects, as I mentioned earlier, will fail the quality of calculation due to the low quality of assumptions. So there is no, you can assume pretty much everything if you can justify it robustly, whether that is with an off-taker agreement, for instance, whether it is with any other thing. I can give you an example. We had a project where the operational hours for district heating were reduced in the summertime because there's no need for summertime heating in most countries. And so we had an off-taker agreement justifying this, and one of our assumptions was that during 3 months out of the year, we weren't going to produce as much energy, and this had an impact. So all of these things impact. If you have the way to mitigate, to your point, the way to mitigate any of these pitfalls is to justify them, justify any assumptions that falls out of the scope, the usual scope.
Thanks, Risha. I'll give you a quick break there because I saw one I can answer from Thomas. Will there be quota for each member state to share the funding allocation? No. So it's basically whatever project scores the most points. Now, sometimes it can come down to tiebreakers, and that's and after the first two tiebreaker, there is a geographic tiebreaker. So say, for example, an Irish project's on the exact same points as a German one, and the other tie breaks didn't break it. Ireland would get it, but it would be very rare. But no, there isn't a sort of pot of money set aside for each member state. It's for the best projects. We'll go back now to the greenhouse gas. How do we handle process emissions, example from limestone, in the baseline versus project scenarios within the greenhouse gas calculator, integration, carbon capture?
So this is a very specific question, and I'm not sure I can answer all of it. But the limestone calcination, I'm assuming we can cover. We're talking about, for instance, a lime kiln, as I've been talking about throughout the presentation. Assuming we are discussing fuel replacement in the lime kiln, then your baseline or your reference scenario is your conventional fuel, let's say natural gas. That's your baseline. That's the emissions that you're going to present. So how much fuel do you need to produce X amount of lime? That's your baseline. And then assuming in the project scenario, you're producing the same amount of lime because you have to maintain that constant, then what is your project? What is your boundary? So are you replacing that natural gas with biomass? Then you have to put the biomass and you have to justify the sustainability of the biomass. And you need to input it line by line. The carbon capture, so maybe it's not biomass, then you'd be capturing carbon and producing fuel to feed the lime kiln, if I'm understanding the question correctly. But it's very similar to the process, the example I just showed you, which is you input line by line every single feed stock into the boundary, and then you remove the carbon capture. So how much carbon are you capturing to then use later at a later stage in your process? I'm not sure if that answered your question. I can, if you want a more specific answer, you can input it here or hand it to Toby or Ross, and then I'll get back to you with a more specific answer as well.
Yeah, and that's going for anyone. If there are questions, you can email them to our inbox, Innovation Fund at dcee.gov.ie, and we'll be able to forward them on. Next question, can we claim bonus GHG saving from delivering grid frequency services which displaces fossil fuel generator by third parties in remote locations?
I would naturally say no, because you can't claim bonus points from if you're not controlling this location, let's say. So I will naturally say no, but we would have to check case by case to make sure it makes sense. But usually we only cover the emissions within project boundaries. So even in bonus points, we can't we shouldn't claim anything positive for us that's outside the project boundary, but then not consider a negative term, let's say, that's also outside the project boundaries just because it doesn't benefit us. We need to be coherent in our assumptions. So if we're talking about a third party in a remote location that's going to be outside the project boundary, to claim this bonus point, you would have to look at what else is outside the project boundary and include all of that in the bonus as well. So we can't pick and choose what we claim in the bonus. It needs to be consistent and coherent. Otherwise, that goes against us in quality of calculation. Okay. The next question, are Scope 3 emissions a must? No, they're not. Again, you only should consider what we control. You do not go into upstream emissions. You do not go into downstream emissions unless it makes sense for you, and you need to duly justify that. So a good example of that is that catalyst that I was talking about. We use the catalyst, but its emission factor was really, really low. And we only used it because it was it degraded over time in our process. And so we had to consider it, but we do not consider the upstream emissions of that catalyst. Okay.
Risha, we've just got a question in the room before we go to the next one. Michael, go ahead.
Thank you. I was a bit confused by the emission factor 0 for electricity. So how does this work when you electrify a heat process, for example?
Okay, so go ahead.
No, yeah, that's the question. I think you get it. Yeah.
Okay, so the emission factor is 0 in most cases in the project scenario because Innovation Fund aims at decarbonization and it doesn't want to penalize anyone for electrifying. And it's also working under the assumption that in 2050, the European Union will be using in its entirety renewable electricity, and so the emission factor will be closer to 0. Now, when we're talking about there are specific cases where the emission factor for the electricity is not 0, and renewable energy is 1. So when we're talking about replacing electricity or an electric something with a renewable energy source, so renewable electricity, then the reference scenario electricity emission factor will not be 0. When we're talking about electrifying, then in the project scenario, assuming the electrification is our aim, then electricity will be 0, and most likely you will have a relative emission avoidance of 100%. I'm not sure if that was your question.
Yeah, thanks, Risha. And just the last one on Slido then, can we discuss the GHG saving from an electricity boiler producing steam to replace an old 70% natural gas boiler in a dairy facility? What is the benchmark?
So the benchmark would be, GHG from an electricity producing steam to replace. Right, so the benchmark would be the natural gas boiler. The reference scenario would be the natural gas boiler. So that is that is where you go to. It will be the natural gas boiler. That's your reference scenario. You use as an emission factor the IF fossil fuel comparator in the ref scenario. In the project scenario, you then use electricity as your input, and electricity doesn't have an emission, or its emission factor is 0.
Perfect. Thanks, Risha. Anyone else in the room, or no? We can continue. Thank you, Risha.
Okay, perfect. So, going to share my screen again. Now, jumping into renewable energy sources, this category applies to innovative renewable energy products for the purpose of generating electricity, heat, or cooling. So we usually have three possible project types for this category. We have the generation of dispatchable or non-dispatchable electricity, heating, or cooling from renewable sources. We have the actual manufacturing of components for renewable energy installations, and we have then the use of renewable energy in activities not covered under the EU ETS benchmarks. If you can see here, for instance, in the use of renewable energy in activities not covered under Annex 1 of the ETS directive, we have the renewable, for the reference scenario, we have the renewable energy consumed by the project times the emission factor.
Rita, we just lost you there.
Can you hear me now?
Yep.
Oh, okay, good. Sorry about that. Don't know what happened. So, like I was mentioning, renewable electricity, we use how much energy we're going to produce in our project as the baseline for our reference scenario. So if we want to produce X amount of energy, that's the amount of energy that we're going to use in our reference scenario, and we're going to multiply it by the emission factor of electricity, which in this case, it does have an emission factor. It's stated in the methodology. For the project scenario, in this case, we don't have any emissions because electricity under Innovation Fund, renewable electricity is 0. Okay, so because we're replacing conventional energy production, we do have an emission factor for electricity. So in the renewable energy category, the reference scenario has been predefined for all projects producing the same output of principal products despite regional differences observed in real life. This is so that all projects can be basically put together against a benchmark and that they can be fairly compared when the experts are analyzing it. So this is quite a simple calculation, the calculator for renewable energy sources. It's one of the simpler calculators, but we're going to show you quickly a case study for the geothermal power production. So this is something that I mentioned earlier. So this is a binary cycle power plant with a production of, this is wrong, the objective here, but it's a binary cycle power plant, a geothermal well, and the category is obviously renewable energy sources. The sector is geothermal energy. The principal product is heat, and we, in this case, did not have a non-principal product. So our reference scenario is the amount of heat to be delivered by our new power plant multiplied by the heat emission factor, which is the EU ETS benchmark, and it's this value right here. And then our project scenario emissions are the electricity imported from the grid and consumed at project site. So we have the grid electricity consumption, the heat consumption, the steam consumption, the production, the working fluid consumption, and the steam balance. All of these, they add up to 0, basically. So in the reference scenario, we have the net amount of heating to be delivered by the renewable technology. We have our, which is here 550 terajoules. We have our emission factor here, and then we have our emissions, our total emissions over the 10 years, which is the 26,000 tons. And then here, in the project scenario, we have the amount of electricity important from the grid, which is 5,000. This is 5,000 megawatt hour. This is how much we need to feed our power plant. We have the heat consumed, which is 0. We have the quantity of steam, which we don't have. We have the amount of working fluid consumed, which is over the 10 years, 4 tons. And we have the amount of steam entering the geothermal minus quantity leaving. This is the leakage, which we justified in this case that there wasn't any perceivable leakage. And so if we look at it here, we have 0 emissions throughout. And so our emission avoidance is 100% in this case. Again, this is a real life scenario that we submitted. The numbers are different, but the overall concept is the same. Are there any questions? Okay, moving on to energy storage. Again, quite a simple calculation. So the energy storage category applies to projects that store energy, as the name says. So electricity, heat, cold, hydrogen, all of these can be considered under energy storage, and includes the following 3 different sectors. So intradaily electricity storage, other energy storage. So here we have hydrogen and heat storage, and then the manufacturing of components for the energy storage plants. For the energy storage itself, so I'm not going to go over the manufacturing of components. For the energy storage itself, we have the net energy stored delivered by the project times the emission factor of this energy. And then we have the grid services delivered times this emission factor. In the ref scenario, in the project scenario, similar to that, we have the gross amount of energy fed into energy storage multiplied by the emission factor, and then the amount of energy consumed on site multiplied by the emission factor. So similar to the renewable energy sources category, for energy storage projects, the reference scenario is based on the emissions that would result from providing the same service using conventional technologies, and is predefined in methodology. We don't really have a lot of leeway here. So for both these categories, defining reference scenario for auxiliary services is complex, and as they impact the service efficiency rather than the quantity. And so when there is that case, we must tailor scenarios to the service specifics and local context. So let's identify the main output and scope of the project. As always, identify a conventional pathway for the production of the same service. Identify and provide the main numerical data required. And here we have to justify all of our assumptions, as I've been mentioning. And then finally, we calculate. So we have here below an example. So the project provides reactive power. An equivalent service to this is provided by a gas-fired turbine working below optimal condition. The problem formulation would be a turbine providing the equivalent service would have an efficiency of 45% instead of 55% with a loss of 10%. And then thanks to this reactive power, the gas turbine efficiency loss, and the emission factor of natural gas, it is possible to calculate the increase of emissions. So similar to the energy intensive industries case, some parameters are fixed. And we can't really change them. So the emission factors for fuels and heat, as we mentioned, so we need to use the EU ETS benchmarks, as we mentioned. For energy storage projects, fixed parameters are also given for heat and hydrogen storage. This is specific. For emission factors for renewable energy, the reference scenario should consider whether the electricity is dispatchable or not. This is an important consideration. And then in the project scenario, the electricity use is always 0, when in the reference scenario, it will not be. Energy storage, however, the electricity stored has emissions equal to 0. The one discharged by the project, however, we have an emission factor of 140 grams of CO2 equivalent per megajoule. This is all stated in the methodology. So this is just some highlight points that we wanted to bring forth that are usual. That cover a few errors that that we see, and then other fixed parameters as well. The transportation that we've talked about, the losses for electrical, gas, and heat grids. And some of those and some others that are stated in the methodology. Finally, I do want to cover briefly mobility projects. We do not have a use case for mobility projects, but because this new category of mobility is very specific. So it covers 2 types of projects. The ones that provide transportation services as their principal product and aim to reduce energy use per functional unit, or projects that aim to manufacture innovative aircraft, maritime vessels, road vehicles, or their components. So these are 2 very specific and distinct types of projects. And so we don't have a use case, and there weren't many submitted this last call as similar to the buildings project. But just to highlight, we should consider the energy used for the delivery of the transport services, any fugitive emissions due to intentional or non-intentional releases of gases, any additional non-CO2 climate impacts, such as black carbon for aviation and maritime projects, and then emissions due to the energy use in the supporting infrastructure for aviation and maritime activities. This is optional, but we should try to include it when possible. And the reference scenario is not predefined as in the renewable energy and energy storage categories, but it does have some points to consider. So the mode of transport must match the project scenario. So if we're talking about road, if we're talking about aviation, maritime, this needs to be considered. Service level, so the same quantity of services or products as in the project scenario. So we need to have an equivalent transport performance. The fuel type, there is in the methodology predefined fuel categories that we should select. And then the same thing with the fuel consumption. We should apply default values for specific fuel consumption per functional unit. And this ends our our individual categories portion of the session. I'm now going to discuss briefly hybrid projects. As we mentioned earlier, when a project combines activities for more than one category, then we consider it a hybrid project. The selection or the consideration of a hybrid project cannot be taken lightly. We need to really be sure that we're talking about a hybrid project first, because in terms of effort, a hybrid project application is much more relevant than a single category project application, but more so because in the GHG calculation, as we mentioned earlier, we will have to use, let's say, two calculators, 2 templates from the 2 categories that we're talking about, combine them in one single file, and make sure that our total emissions do not consider any double counting or double avoiding. And this, depending on the complexity of the project, can be quite time consuming, energy consuming, and it can lead to some unavoidable errors. So we have here a Venn diagram. So when we're talking about emissions of a hybrid project, we have the emissions avoided by, let's say, project A, and then the emissions avoided by project B, and they overlap with the common emissions. We must try to choose a main category, and we consider the common emissions in the category that we consider to be the principal one. So in this case, let's say we avoid, we choose project A as our main use, as our main goal of the overall project. And so our category A, let's say, is has its own emissions and then the common emissions, and the emissions avoided by project B do not have the common emissions. This is really important. This is a really important exercise to do and to get right. Here on the right, we have some examples of hybrid projects. So we have the production of steel with on-site battery storage, with energy intensive industry and energy storage combining. So if the most revenue comes from the steel production, then the project should apply in the sector iron and steel and follow the correspondent sections for energy intensive industry and energy storage. But most of the project will be in energy intensive. Similarly, when we're talking about a renewable energy plant coupled with a storage system, we should really define our project boundaries. They should be clear, and it should be demonstrated that the power from renewable energy is supplied to the energy storage accordingly. And finally, we have a factory producing ESAF. So this isn't aviation. This is the sector. The category would be mobility. So it can apply as a hybrid project depending on the products. So with this, we've covered most of the categories. We now come into the quality of calculation, what I've been talking about throughout this entire session. And I would say 4 to 5 points that we need to take care when we're preparing the calculation to make sure that we have a high score in the quality of calculation criterion. So first is the scenario. So we need to correctly identify the reference and project scenarios. The project boundaries, the main product and sector must be all coherent, and we must have deeply justified all of these selections, and we need to be clear on it. The second one is the values and sources. So the emission factors should be used according to the hierarchy of sources, which I'm going to show in the next slide. We need, when the emission factors or any other figure, so net calorific value, for instance, is not given by the methodology, by the calculator, we need to make sure that our source is as good as it can be, and that our values are coherent and cohesive with other submission documents throughout the entire application. So all of our numbers must be double and triple checked with the financial plan, with the feasibility study, with the FIF file. All of this must be double and triple checked. If there is a lack of coherence, then that basically puts everything up for debate. Then the calculation is clear and is segregated into several steps. There is a tab in the calculator, which I can show you if you're interested, which is called Assumptions. In this tab, we should input all the values that we have assumed, whether it is load factors, amount of water consumed, amount of electricity, how we calculated production time, operational hours, all of these must be there. If we have a value that is not just a number. So obviously operational hours in a year doesn't need to be a formula, but if you have something that depends on another cell, let's say on a calorific value, then you should put formulas. You should link everything so that the experts can trace back your figures. Instead of just putting 10, do the calculation, do the formula within the calculator itself. Then we have to justify and explain each assumption and referencing anything regarding the GHG methodology. And the final point is data traceability. So at the end, we're applying for a project to be implemented and operated. And so we need to make sure that what we're considering in the GHG calculation can be traceable at operation phase. We can't say that we're going to monitor, I don't know, the quantity of steam that we're producing if we don't have something to monitor the steam production. And finally, I'm just going to leave here the source hierarchy. This is also in the methodology, but we have for fuel combustion emissions, the IPCC document from 2006. It's been refined in 2019. It's linked in the methodology. The most emission factors come from there. We then have the different chemicals emissions. We should use definition of input data to assess GHG default emissions from biofuels, let's say, and then we should use the Joint European Center annexes, which are also linked. For databases, we should use life cycle assessment software such as the EcoInvent. Other official sources, so we can again reference the IPCC, any other reviewed sources, and in last case, peer-reviewed publications if we don't have a better source. And finally, own estimates. We can produce our own estimates and say this is our value, and unreviewed sources from literature. If you choose to present these, then we must really well justify why we're choosing to present our own estimates. Okay, and this is it for my presentation. I can show the Excel calculators if you're interested, to show you the assumptions, mainly the assumptions tab, if you're interested, or we can just skip to questions. I can check.
Yeah, I think, Risha, if you want to quickly show those tabs, and then we can move on to questions. Thank you.
Okay. Okay, so if you can already see, this is for the geothermal power plant that we mentioned earlier. It has a lot of step-by-step.
Sorry, Rita,
yeah.
can you just scroll, zoom in a little bit, please?
Yeah. Is this okay?
Yep.
Okay. So this is the geothermal power plant that I mentioned earlier. And so this is the assumptions tab that we were talking about. So here we must describe everything. So the power plant capacity, maximum power put, we put it here. We described it, what it meant, and then we put our basis for source and our brief description of the monitoring plan for this. Same thing for then the load factor. So we justified it here. We put here the amount, and we have here that any Geothermal power plants claim the highest capacity factor. All of this, we justified why our load factor was 98%. We have here our operating hours. We justified it, justify all of this. And then the working fluid as well. So we have here 0.4 tons per year, which adds up to 4 tons over the 10 years, which we mentioned. So 400 kilograms per year. So this is required to initially fill the well, and we explained it here, why and how much, and what it was basically. And we put here as well the global warming potential of the working fluid, which was 0 because it doesn't have any GHG emissions associated. So this is what we did for the geothermal, and I'm going to show you now for the crude project, which I have here as well.
Rita,
yeah.
The information that's required here to build this model or calculation, who typically owns that information within businesses?
We usually get this from either a feasibility study that has already been conducted or pre-engineering studies. The Innovation Fund is quite a technical heavy application. So we need the technical departments, the engineering departments to be involved from the beginning, because it's fundamental that we have all of this information as soon as possible, really, to understand, to define the project boundaries. And so, yeah, usually it is the technical team, the engineering team usually gives us this. So here, the same thing, basically with the synthetic crude production. We have all the inputs, so fresh water, demi-water, the catalyst used, the steam consumption, all of this we demonstrated here. We calculated, we show our calculation as well in the application. So the part B of the application, all of this has to make sense and has to cross between documents and finally between the financial information file as well, because you're going to pay for electricity, you're going to pay for water, you're going to pay for all of this. So the numbers need to be correspondent. And so what we usually do is I put everything here in the assumptions tab and then link in the project emissions or reference emissions scenario tab to here. So we only have to change it once. And yeah, so this is it. From my side, we do have a little bit of time for questions. I don't know if you want to maybe do we already have one here from Slido.
Yeah, Rita, we'll start with that. And again, if there's anyone in the room, Gary will go around with the mic. So the Slido question, a chemical company has 50% GHG avoidance with scope 1, but downstream emissions arise from processing of its products to end applications. Should scope 3 be used?
Sorry. Yes, I would use end-of-life emissions. In the project scenario, there's a line for end-of-life emissions for the use of your products. We should, if it makes sense for the project, and yes, we should use it. But again, all of these more specific questions really require an in-depth analysis of the case by case, because it may not make sense depending on the project innovation, the project, even financials. It needs to be a very cohesive application. So it all needs to be linked with each other, if that makes sense.
Perfect. And we have a question here. There you go.
Hello. Actually, that was just my question.
Okay.
But there seems to be some confusion as to how far one has to go in the supply chain, and we don't seem to be able to get any answer on that. So if anything can be shared, because that can determine whether a project is eligible or not.
Yes, so it is quite tricky. It's ambiguous at best. The answers from SINEA, that they're but the truth is, it really does depend case by case. Usually, as I mentioned earlier, usually I would not add emissions from downstream or upstream unless I can justify the reason for those emissions. And this is, if we're talking about downstream emissions, so processing a product, whatever it may be, downstream, your industry, your company is no longer basically covering that emission. You're not responsible for it. The project is no longer responsible for the product at its end of use, end of life, if it's outside our boundary. And so to add any emissions at end of life, we need to justify them. If we can justify with the processing of the product, so as we mentioned earlier, I had the example of methanol being used by the chemical sector, then the emissions from processing the methanol at the chemical plant, those would be end of life, because our project is only covering the production of methanol. So if this is if this makes sense for you, so let's say your product is methanol, you're producing it, these are your emissions, you're processing at a later stage, it's not controlled by you, but it's end of life emissions, then you should add them. But you need to justify this addition, because we can't add emissions at end of life or at bonus, for instance, for other GHG savings, at one stage of the process and not add something that would hurt us at the same stage of the process. We can't pick and choose what we consider in the calculation. If we're opening up our boundary, then we need to open it up for the good and the bad. So in this case, the methanol, for instance, I think it's a good example for your case, no?
Yeah. And just to remind people, I know this can be a minefield and there's a lot of information, but the EU Information Day is always very helpful, but especially the Irish Information Day, which I believe we're having it on the 20th of January in this room. We will give further details in December, but what we do as well, we ask people to submit a small sort of concept note, and the best projects then will get a chance to discuss their project with SINEA, who run the Innovation Fund on behalf of the EU Commission. And I know the feedback from that has always been very positive, and they'll talk through your project with you and your application. If everyone in here should be on our mailing list anyway, but if you're not, please come up to us and we'll get you added, and take advantage of that. And we hope they'll be here in person. It'll be a hybrid event as well. They were here in person last year, but if not, it's a great opportunity to go through it with them. Any other questions in the room, or Risha, sorry for interrupting you, go ahead.
No, I was just going to say what you already said, and I reiterate what I already said as well. If you want a specific answer, if you have a specific question but you're not comfortable sharing it right now, you can share it with Toby or Ross or Aideen, and both me and Miko will answer it with as many details as we can.
Yeah. If there's no other questions, I'd like to thank you all for coming. It is a complicated process, but what you can get back from it is invaluable. And as a national contact point, we're here to help you in any way we can. So please feel free to get in touch. keep an eye out for the core launch at the start of December and the information days, and we'll be sharing as much information to our main list as we get it. And I'm hoping to get more information about the heat auction when it comes out. We only received the terms and conditions last week, so we'll dive into that, and we've got a meeting in Brussels to discuss it next month, and we'll certainly have more information by the info days. So thank you everyone for coming. Again, these slides will be shared and the recording will be online for you to go back over it, and thank you for all your questions and participating in it. Thank you.
Thank you all. Bye.
Rita,